Understanding risk and return. Understanding the fundamental concepts of risk and return is the bedrock of quantitative finance and algorithmic trading. Every investment decision, from a simple stock purchase to a complex derivative strategy, implicitly or explicitly weighs the potential gain against the potential loss. This section will define these core concepts, explore their various forms and quantitative measures, and articulate the crucial trade-off that governs all financial decisions. Defining financial return. Financial return quantifies the gain or loss on an investment over a specific period. It is typically expressed as a percentage of the initial investment. Various methods exist to calculate return, each suited for different analytical contexts. Absolute, simple, return. The most straightforward measure, absolute return, calculates the percentage change in an asset's price or value over a single period. It does not account for compounding or time value beyond that specific period. Formula. R równa się frac P1, P0 ów P0, where $R equals absolute return. $P1 equals price or value at the end of the period. $P0 equals price or value at the beginning of the period. Example. Imagine you buy a stock for $100 and sell a year later for $110. $R equals frac $110. $100 $100 equals frac $100 equals 0.10 text or 10 %. This indicates a 10% return on your initial investment over that year. Arithmetic mean return. When analyzing returns over multiple periods, the arithmetic mean return is simply the sum of returns for each period divided by the number of periods. It's useful for understanding the typical return in any given single period, but it can be misleading when considering compounded growth over time. Formula. $bar R A equals frac R1 plus R2 plus dot plus R and $, where $bar R A equals arithmetic mean return. $E equals return in period $I. $and equals number of periods. Context. The arithmetic mean is commonly used for calculating the average annual return when returns are independent and not reinvested. However, it overstates the actual compound growth rate over multiple periods. Geometric mean return. The geometric mean return is a more accurate measure of an investment's performance over multiple periods, especially when returns are compounded. It accounts for the effect of compounding, reflecting the true average annual growth rate. Formula. $bar R G equals 1 plus R1, 1 plus R2, dots, 1 plus RN, caret, 1 slash $1, where $bar R G equals geometric mean return. $E equals return in period $I. $and equals number of periods. Context. The geometric mean is preferred for calculating average multi-period returns, particularly for long-term investment performance, as it reflects the actual compounded growth of an investment. Logarithmic, continuous compounded, return. Logarithmic returns, also known as continuously compounded returns, are derived using the natural logarithm of the price ratio. They possess desirable mathematical properties, such as additivity over time, making th. And particularly useful in quantitative models, portfolio optimization, and risk management. Formula. $R log equals \ln left, frac P1 P0 right $, where $R log equals logarithmic return. $ln equals natural logarithm. $P1 equals price at the end of the period. $P0 equals price at the beginning of the period. Context. Log returns are often preferred for their analytical tractability. They are symmetric. A 10% gain and a 10% loss have equal magnitude but opposite signs when expressed as log returns, unlike simple returns. They also allow for simple summation over multiple periods to get the total return for the entire period. Annualizing returns. Financial returns are often presented on an annualized basis to allow for direct comparison between investments with different time horizons. To annualize returns, we typically scale the periodic return by the number of periods in a year. Formula for simple returns. $R/text annual equals 1 plus R/text period caret K, $1. Where $R/text annual equals annualized return. $R/text period equals return for the period, e.g. daily, monthly. $K equals number of periods in a year, e.g. 252 for daily, 12 for monthly. Formula for logarithmic returns. $R/text annual equals R/text period times K $. Logarithmic returns are directly scalable, making annualization simpler. Calculating returns in Python. Let's demonstrate how to calculate these different types of returns using Python, leveraging the code snippet library for efficient data handling. We'll start a sample series of hypothetical daily closing prices. First, we need to import code snippet and code snippet. Download the code on OnePageCode Substack. This initial code block sets up our sample price data using a Panda series. We've created 10 hypothetical daily closing prices and assigned a code snippet to simulate real financial data. The code snippet specifies business day frequency. Now, let's calculate the daily simple returns. Pandas provides a convenient method for this. Download the code on OnePageCode Substack. The code snippet method is ideal for calculating simple returns for each period. The first value will be code snippet because there is no previous price to compare against. Next, we calculate the daily logarithmic returns. Download the code on OnePageCode Substack. Logarithmic returns are calculated by taking the natural logarithm of code snippet. This transformation is often used in quantitative finance due to its mathematical properties. Finally, let's look at annualizing these returns. We'll assume 252 trading days in a year for daily data. Download the code on OnePageCode Substack. This snippet demonstrates the two different methods for annualizing returns based on whether they are simple or logarithmic. The choice between code snippet and code snippet for log returns depends on whether you want the average daily log return annualized or the total log return over the period annualized. Here, we calculate the average daily log return and then annualize it. Defining financial risk. Financial risk refers to the uncertainty surrounding the actual returns an investment will generate. It's the possibility that the actual outcome will differ from the expected outcome, potentially leading to a loss. Risk is an inherent part of investing, and understanding its various forms and how to measure it is crucial for managing portfolios. Quantitative measures for risk. While risk can manifest in many forms, in quantitative finance, it is often quantified by the variability or dispersion of returns. Variance and standard deviation volatility. The most common quantitative measure of risk is the standard deviation of returns, often referred to as volatility. Variance measures how far a set of numbers, returns, are spread out from their average value. It is the average of the squared differences from a mean. Standard deviation is the square root of the variance. It is preferred over variance because it is expressed in the same units as the data, e.g., percentage points for returns, making it easier to interpret. A higher standard deviation indicates greater price fluctuations and, therefore, higher risk. Formula: sample standard deviation. Dollaro barra inversa sigma uguale barra inversa SQRT barra inversa frac barra inversa sum uguale 1 o i barra inversa bar o 2 meno 1 i dollaro. Where $sigma dollar equals standard deviation volatility. $dollar equals return in period $I dollar. $bar R dollar equals mean return. $$ equals number of observations. Calculating volatility in Python. Using our previously calculated daily returns, we can easily compute their standard deviation. Download the code on OnePageCode Substack. This code calculates the standard deviation for both simple and logarithmic returns. Note that for small returns, the values will be very close. Annualizing volatility. Similar to returns, volatility is also often annualized to provide a comparable measure over a yearly period. For daily data, we typically multiply the daily standard deviation by the square root of the number of trading days in a year, e.g., $/QRT, $252. This square root factor arises from the assumption that daily returns are independent and identically distributed, i.d. Download the code on OnePageCode Substack. Annualizing volatility correctly involves multiplying by the square root of the number of periods, reflecting how risk accumulates over time. Other risk measures, conceptual. While volatility is a primary measure, other risk metrics provide different insights. Beta, $/beta$, measures the sensitivity of an asset's returns to the returns of the overall market. A beta of 1 means the asset moves with the market. Greater than 1, it's more volatile. Less than 1, it's less volatile. Value at risk, VAR estimates the maximum potential loss over a specified time horizon at a given confidence level, e.g., we are 99% confident that the loss will not exceed $1 million over the next day. Types of risk. Beyond quantitative measures, it's crucial to understand the qualitative categories of financial risk. Market risk, systematic risk. Explanation. The risk that an investment's value will decline due to factors affecting the overall market, rather than specific to the company or asset itself. This risk cannot be eliminated through diversification. Examples: economic recessions, geopolitical events, changes in interest rates, widespread industry downturns. A general stock market crash would be an example of market risk. Credit risk, default risk. Explanation. The risk that a borrower, e.g., a company, government, or individual, will fail to meet its financial obligations, such as making interest payments or repaying the principal on a bond. Examples: a company issuing bonds goes bankrupt and cannot repay bondholders. A country defaults on its sovereign debt. Liquidity risk. Explanation. The risk that an asset cannot be bought or sold quickly enough in the market without substantially affecting its price. Illiquid assets may be difficult to convert to cash without incurring significant losses. Examples: trying to sell a large block of shares in a thinly traded small-cap stock quickly, selling a unique piece of real estate in a slow market. Operational risk. Explanation. The risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. Examples: employee fraud, system failures, e.g., trading platform glitches, data breaches, natural disasters affecting business operations, human error in trade execution. Absolute versus relative risk. Absolute risk refers to the total risk of an investment in isolation. When we discuss volatility, standard deviation of an asset's returns, we are typically referring to its absolute risk. It measures the overall variability of returns without comparison to a benchmark. Relative risk measures the risk of an investment relative to a specific benchmark or another investment. For example, tracking error, the standard deviation of the difference between portfolio returns and benchmark returns, is a measure of relative risk. Beta is also a form of relative risk, measuring an asset's volatility relative to the market. Investors often consider relative risk when they are trying to outperform a specific index. The fundamental risk-return trade-off. One of the most fundamental principles in finance is the risk-return trade-off. Higher potential returns typically come with higher risk, and lower risk investments usually offer lower potential returns. Investors are compensated for taking on more risk. The primary goal of an investor is not simply to maximize return, but to maximize return for a given level of risk, or equivalently, to minimize risk for a desired level of return. Hypothetical scenario: bond versus stock. Consider two hypothetical assets. 1. Asset A, government bond, low risk, but offers a modest, predictable return, e.g., 2% per year. 2. Asset B, growth stock, high risk, with the potential for much higher returns, e.g., 15% per year, but also significant potential for losses. An investor seeking stability and capital preservation might choose the bond, accepting lower returns. An investor with a higher risk tolerance and a long-term horizon might opt for the stock, hoping for greater wealth accumulation despite the higher volatility. This illustrates the trade-off in practice. Risk-adjusted return. Since investors care about both risk and return, simply looking at return in isolation is insufficient. Risk-adjusted return measures an investment's return relative to the risk taken to achieve that return. It allows for a more meaningful comparison of investments with different risk profiles. A common metric for risk-adjusted return is the Sharpe ratio. While we will delve into this in detail in later sections, conceptually, the Sharpe ratio measures the excess return above the risk-free rate, per unit of total risk, standard deviation. A higher Sharpe ratio indicates a better risk-adjusted performance. Conceptual formula, Sharpe ratio. $\text Sharpe ratio equals \frac RP RF \sigmap $, where $RP equals portfolio return. $RF equals risk-free rate. $sigmap equals portfolio standard deviation risk. Comparing risk-return profiles in Python. Let's create a simple Python function to compare two hypothetical assets based on their annualized return and volatility, reinforcing the trade-off concept. Download the code on OnePageCode Substack. This function takes the names, returns, and volatilities of two assets and print. As a comparison, it demonstrates how, in most real-world scenarios, a higher return comes with higher risk, forcing a trade-off decision. Limitations of historical risk and return. It is critical to understand that historical risk and return metrics are backward-looking. While they provide valuable insights into past performance, they are not perfect predictors of future performance. Past performance is not indicative of future results. Market conditions, company fundamentals, and economic environments are constantly changing. Black swan events, rare, unpredictable events like the 2008 financial crisis or the COVID-19 pandemic, can drastically alter market dynamics in ways that historical data might not fully capture. Stationarity assumption. Many quantitative models assume that asset returns are stationary. Their statistical properties, like mean and variance, do not change over time. In reality, this assumption often breaks down, especially during periods of market stress. Therefore, while historical analysis is a crucial starting point, it must be complemented with forward-looking analysis, scenario planning, and robust risk management techniques. Benchmarks and risk-free rate. Financial benchmarks. Financial benchmarks are reference portfolios or indexes used to evaluate the performance of an investment or portfolio. They provide a standard against which an investment success can be measured. Examples: the S&P 500 for large-cap U.S. equities, the Russell 2000 FO, are small-cap U.S. equities, the Bloomberg Global Aggregate Bond Index for global investment-grade bonds. Purpose: to determine if an investment strategy is outperforming or underperforming a relevant market segment. For instance, a fund manager aiming to beat the S&P 500 would compare their portfolio's returns to the S&P 500's returns. Risk-free rate. The risk-free rate is the theoretical rate of return of an investment with zero risk. In practice, no investment is truly risk-free, but government securities, like U.S. Treasury bills, are often used as proxies due to their extremely low default risk. Purpose: the risk-free rate serves as a baseline for evaluating investments. Any return above the risk-free rate is considered excess return and represents the compensation an investor receives for taking on risk. It's a critical component in calculating risk-adjusted returns like the Sharpe ratio. The fundamental risk and return trade-off. In the realm of quantitative finance and algorithmic trading, a foundational principle dictates the relationship between potential reward and inherent danger. The risk and return trade-off. Simply put, to achieve higher potential returns, an investor typically must assume greater risk. Conversely, investments promising lower returns usually come with lower risk. This inverse relationship is central to all investment decisions, from selecting individual assets to constructing complex portfolios, quantifying risk and return. Before delving deeper into the trade-off, it's crucial to understand how risk and return are quantitatively measured in practice. Return is typically measured as the percentage gain or loss on an investment over a specific period. For historical analysis, we often use historical returns, which can be calculated daily, weekly, monthly, or annually. Risk, in the context of quantitative finance, is most commonly proxied by volatility. Volatility refers to the degree of variation of a trading price series over time. A widely used statistical measure for volatility is the standard deviation of returns. A higher standard deviation indicates greater price fluctuations and, therefore, higher risk. Let's illustrate this by calculating historical returns and standard deviation for a few common assets. We'll use code snippet to fetch historical data for the S&P 500 SPY and a U.S. Treasury bond ETF, TLT. First, we need import the necessary libraries and define our assets. Download the code on one Pagecode Substack. Here, we import code snippet to download financial data, code snippet for data manipulation, code snippet for numerical operations like standard deviation, and code snippet for plotting. We then define a list code snippet with SPY, S&P 500 ETF, representing broad market equities, and TLT, iShares 20-plus year Treasury bond ETF, representing long-term government bonds. Next, we'll download the historical data and calculate daily returns. Download the code on one Pagecode Substack. We specify a code snippet and code snippet to fetch a consistent period of historical data. Code snippet retrieves the ADJ close price, which accounts for dividends and stock splits. We then calculate code snippet on the adjusted close prices to get the daily percentage returns, and code snippet removes any code snippet values that result from the first row of code snippet. Now, we can compute the annualized average return and annualized standard deviation, risk, for each asset. Download the code on one Pagecode Substack. To annualize daily returns, we multiply the average daily return by 252, the approximate number of trading days in a year. For standard deviation, we multiply the daily standard deviation by the square root of 252. This scaling factor accounts for the time horizon when converting daily volatility to annual volatility. The results are then stored in a code snip. PET for easy viewing. Finally, we can visualize these assets on a risk-return scatter plot. Download the code on one Pagecode Substack. This code generates a scatter plot where the x-axis represents risk, annualized standard deviation, and the y-axis represents return, annualized return. Each point on the plot corresponds to an asset. You would typically observe that SPY, being an equity ETF, plots to the right and potentially higher than TLT, a bond ETF, illustrating that equities generally offer higher returns, but also higher volatility compared to bonds. The risk-return spectrum and market efficiency. When visualizing assets on a risk-return plot, you'll observe that most viable investments tend to fall along an upward-sloping curve. This curve represents the efficient frontier, where for any given level of risk, an asset or portfolio offers the highest possible expected return, or for any given expected return, it offers the lowest possible risk. Consider the four theoretical quadrants of a risk-return graph. 1. High return/high risk. This is where assets like growth stocks, emerging market equities, or certain derivatives, e.g., highly speculative options, typically reside. They offer the potential for substantial gains, but also carry a significant risk of loss. Our SPY example often falls into this category relative to bonds. 2. Low return/low risk. Assets like U.S. Treasury bonds, money market funds, or stable blue-chip stocks generally fall here. They provide modest returns with relatively low volatility. Our TLT example is a good representative. 3. High return/low risk. This quadrant is highly desirable, but in an efficient market is rarely sustainable. If an asset consistently offered high returns with low risk, every rational investor would flock to it. This massive demand would drive its price up, consequently lowering its future expected return until it aligns with the market's efficient frontier. Such opportunities are quickly arbitraged away by market participants. 4. Low return/high risk. This quadrant is highly undesirable and also unlikely to persist. No rational investor would knowingly choose an investment that offers poor returns for significant risk when better alternatives exist. Assets that temporarily fall into this category, e.g., a company in severe distress, would see their prices plummet as investors sell off, potentially driving their future expected returns higher due to lower entry price, until they move out of this undesirable zone or they simply cease to be viable investments. The absence of consistently available assets in the high return/low risk and low return/high risk quadrants is a testament to the concept of market efficiency. In an efficient market, asset prices reflect all available information, and opportunities for abnormal, risk-adjusted returns are quickly exploited and disappear. Investor-specific factors, risk tolerance, and time horizon. The optimal risk-return trade-off (FF) is not universal. It is highly personalized and depends on several investor-specific factors. Risk tolerance. This is an individual's psychological willingness and financial ability to take on risk. Aggressive investors have a high risk tolerance. They are comfortable with significant price fluctuations and potential losses in pursuit of higher long-term returns. They might allocate a larger portion of their portfolio to equities, emerging markets, or even alternative investments. Conservative investors have a low risk tolerance. Their priority is capital preservation and stable, albeit modest, returns. They tend to favor bonds, money market funds, and dividend-paying stocks. Investment horizon. This refers to the length of time an investor expects to hold an investment before needing the funds. Longer horizon. Investors with a long time horizon, e.g., young individuals saving for retirement over 30-plus years, can typically afford to take on more risk. They have time to recover from market downturns, and the higher potential returns of riskier assets can compound significantly over decades. Short-term volatility tends to average out over longer periods. Shorter horizon. Investors with a short time horizon, e.g., saving for a down payment on a house in 2 to 3 years, generally should take less risk. They cannot afford significant losses, as there might not be enough time to recover before the funds are needed. Case study. 2 hypothetical investors. Let's consider 2 individuals. Alice, age 25. Aggressive investor Alice is just starting her career and saving for retirement. She has a high income, no dependents, and a 40-year investment horizon. She is comfortable with market volatility, understanding that historical data suggests equities tend to outperform bonds over very long periods. Her optimal risk-return trade-off would likely involve a portfolio heavily weighted towards equities, e.g., 80 to 90% stocks, 10 to 20% bonds, aiming for higher long-term growth despite short-term fluctuations. Bob, age 60. Conservative investor Bob is nearing retirement and plans to start drawing income from his investments in 5 years. His primary goal is capital preservation and generating stable income. He cannot afford significant losses as he has limited time to recover. His optimal risk-return trade-off would lean towards a more conservative portfolio, e.g., 30 to 40% stocks, 60 to 70% bonds, and cash equivalents, prioritizing stability and income over aggressive growth. These examples highlight how personal circumstances profoundly shape the right balance between risk and return. Risk and return in portfolios. The power of diversification. While the risk-return trade-off applies to individual assets, its application to portfolios introduces a critical concept: diversification. Diversification is the strategy of spreading investments across a variety of assets to mitigate risk. The core idea is that different assets respond differently to the same market events. When one asset performs poorly, another might perform well, offsetting losses and stabilizing overall portfolio returns. The key to effective diversification lies in combining assets that are not perfectly positively correlated. When assets have low or negative correlation, Combining them can reduce the overall portfolio's standard deviation risk without necessarily sacrificing expected return. This is the central tenet of modern portfolio theory, MPT, a framework that formalizes how rational investors can construct portfolios to optimize expected return for a given level of market risk. Let's demonstrate the effect of diversification by combining our two assets, SPY and TLT, into a simple portfolio. Download the code on OnePageCode Substack. The code snippet method calculates the covariance between the daily returns of SPY and TLT. We annualize it by multiplying by 252. The code snippet method gives us the correlation coefficient, which is a standardized measure of how two assets move together. A low or negative correlation between SPY and TLT is what allows for diversification benefits. Now, we can calculate the portfolio's expected return and standard deviation for various weightings between SPY and TLT. Download the code on OnePageCode Substack. This loop iterates 100 times, creating portfolios with different weightings of SPY and TLT, e.g., 0% SPY / 100% TLT, 1% SPY / 99% TLT, 100% SPY / 0% TLT. For each portfolio, we calculate its expected return, a weighted average of individual asset returns, and its standard deviation. The portfolio standard deviation calculation uses the covariance matrix, which accounts for how the assets move together. This is where the diversification benefit manifests. The portfolio's risk is often less than a simple weighted average of individual risks. Finally, we plot these portfolios to visualize the diversification effect. Download the code on OnePageCode Substack. The plot will show a curved line representing the portfolios. Notice how the curve bends to the left of a straight line connecting the two individual assets. This bend illustrates the diversification benefit. By combining assets, you can achieve a lower overall portfolio risk for the same level of return, or a higher return for the same level of risk, compared to holding just one asset or a simple linear combination. The point on the curve furthest to the left represents the minimum variance portfolio, which has the lowest possible risk for any combination of these two assets. Advanced frameworks, CAPM and MPT. While we've touched upon the practical implications, it's worth noting that the risk-return trade-off is formalized by several advanced financial theories. Modern portfolio theory, MPT, developed by Harry Markowitz. MPT provides a framework for constructing portfolios to maximize expected return for a given level of risk. It emphasizes the importance of diversification and the covariance between assets. The curve we plotted above for the two-asset portfolio is a simple example of an efficient frontier, a core concept in MPT. Capital Asset Pricing Model, CAPM, building on MPT. CAPM relates the expected return of an individual asset to its systematic risk, non-diversifiable risk, often measured by beta. It suggests that investors are only compensated for systematic risk, as unsystematic, diversifiable risk can be eliminated through diversification. While beyond the scope of this section's mathematical detail, understanding that such models exist provides a valuable conceptual bridge to more advanced quantitative finance. High-risk / high-return instruments, derivatives. Specific financial instruments are inherently positioned at the higher end of the risk-return spectrum due to their design and leverage potential. Derivatives, such as options and futures contracts, are prime examples. Options. These contracts give the holder the right but not the obligation to buy call option or sell put option, an underlying asset at a specified price before a certain date. Options trading can offer substantial returns due to their leverage. A small price movement in the underlying asset can lead to a large percentage gain or loss in the option's value. However, this leverage also means options can expire worthless, leading to a 100% loss of the premium paid. Futures. These are standardized contracts to buy or sell a specific asset at a predetermined price on a future date. Futur en volage. A leverage, meaning a small initial margin deposit, can control a large notional value of the underlying asset. While this amplifies potential gains, It also significantly magnifies potential losses beyond the initial margin, making them high-risk instruments if not managed properly. The use of these instruments requires a deep understanding of their mechanics, underlying market dynamics, and robust risk management strategies. Common pitfalls and best practices. Understanding the risk-return trade-off is fundamental, but misinterpretations can lead to costly mistakes. Past performance is not indicative of future results. While historical data is used to estimate risk and return, it's crucial to remember that market conditions change. An asset that performed well historically might not do so in the future. Ignoring transaction costs and taxes. These factors can significantly eat into returns, especially for active traders. Emotional investing. Fear and greed can lead investors to make irrational decisions, such as selling during downturns, locking in losses, or buying into speculative bubbles, chasing high returns without proper risk assessment. Over-diversification. While diversification is good, excessive diversification can dilute returns and make a portfolio difficult to manage without significantly reducing overall risk. Not understanding your own risk tolerance. A common pitfall is to take on more risk than one can emotionally or financially bear, leading to panic selling during market corrections. Regularly reassess your risk tolerance as your life circumstances change. By diligently applying the principles of the risk-return trade-off, understanding quantitative measures, and employing diversification, investors can construct portfolios aligned with their personal financial goals and risk appetites. Analyzing returns. Financial returns are the cornerstone of quantitative finance, serving as the primary metric to evaluate the performance of an investment. Understanding how to calculate and interpret returns is fundamental to assessing profitability, managing risk, and comparing different investment opportunities. Defining financial returns. At its most basic level, a financial return represents the profit or loss an investment generates over a specified period. This can be expressed in two primary ways: absolute change and percentage change. While absolute change, the dollar amount of profit or loss, might seem intuitive, it is often misleading for comparative purposes. Consider two scenarios. Scenario: a stock priced at $50 increases by $5. Scenario B: a stock priced at $500 increases by $5. In both cases, the absolute gain is $5. However, the proportional gain is vastly different. A $5 gain on a $50 stock represents a 10% increase, whereas a $5 gain on a $500 stock is only a 1% increase. This stark difference highlights why percentage returns are indispensable. They standardize performance, allowing for direct and meaningful comparisons across assets with vastly different price points or capital requirements. The most common method for calculating a single-period percentage return is the simple holding period return. It measures the return an investor would realize by holding an asset for one period, from timecode snippet to timecode snippet. The formula for simple percentage return is $RT equals \frac st, st, 1 is t, $1, where $RT, the simple return for the period ending at timecode snippet, $ST, the asset's price or value at timecode snippet, the end of the period, $ST, $1, the asset's price or value at timecode snippet, the beginning of the period. This formula effectively calculates the price change relative to the initial investment, expressing it as a percentage. Calculating simple returns, a numerical example. Let's illustrate the calculation of simple returns with a small set of dummy stock prices. Imagine we have the closing prices for a hypothetical stock over 3 consecutive days. Day 1, T, $100. Day 2, T, $105. Day 3, T plus 1, $102. First, let's calculate the simple return for the period from day 1 to day 2. $R\text day 2 equals \frac s\text day 2 s\text s\text equals \frac $105.00 backslash $100.00 backslash $100.00 equals backslash frac backslash $5.00 backslash $100.00 equals 0.05 equals 5 backslash percent $. Next, let's calculate the simple return for the period from day 2 to day 3. $R backslash text day 3 equals backslash frac as backslash text day 3 s backslash text day just backslash text day 2 equal backslash frac backslash $102.00 backslash $105.00 backslash $105.00 equals backslash frac dash backslash $3.00 backslash $105.00 backslash approximate dash 0.02857 equals dash 2.857 backslash percent $. As you can see, the stock gained 5% from day 1 to day 2, and then lost approximately 2.857% from day 2 to day 3. These percentage figures offer a clear, standardized view of performance across different periods. Implementing simple returns in Python. In real-world quantitative finance, price data is typically obtained from financial APIs, like Yahoo Finance, AlphaVantage, or data providers, e.g., Bloomberg, Refinitiv. This data usually comes in the form of time series, which are efficiently handled using libraries like NumPy and Pandas in Python. Let's begin by demonstrating a basic calculation for a single period, then expand to a series of prices. Basic single period calculation. First, we'll define two prices and calculate the simple return using basic arithmetic. Download the code on OnePageCode Substack. This code snippet directly applies the simple return formula to two scalar values, representing the price at the beginning and end of a single period. The result is a decimal, which can be easily converted to a percentage for readability. Calculating returns for a series, manual approach with NumPy. When dealing with a sequence of prices, we often use code snippet arrays for efficient numerical operations. We can manually iterate or use array slicing to calculate returns for each period. Download the code on OnePageCode Substack. In this segment, we create a code snippet array of prices. We then iterate from the second element, code snippet, onwards, using the current element as code snippet and the previous element, code snippet, as code snippet. The calculated returns are stored in a new code snippet array. Notice that code snippet has code snippet elements for code snippet prices because the first period's return cannot be calculated without a prior price. While the loop approach is clear for understanding, code snippet offers more vectorized and efficient ways to perform such calculations. Download the code on OnePageCode Substack. This vectorized code snippet approach achieves the same result much more efficiently, especially for large data sets. It simultaneously subtracts the entire code snippet array from the code snippet array and then divides by code snippet, eliminating the need for an explicit loop. Leveraging Pandas for efficiency. Code snippet. 4x series data. The code snippet library is the de facto standard in Python. It provides highly optimized data structures like code snippet and convenient methods for financial calculations. The code snippet method is specifically designed to calculate percentage changes between the current and a prior element. Download the code on OnePageCode Substack. The code snippet method is remarkably convenient. It automatically handles the alignment of current and previous values and generates a code snippet of returns. A key observation here is the code snippet, not a number, value at the first position of the code snippet series. This is expected because there is no preceding price for the first data point, making it impossible to calculate a return for that period. This code snippet is a standard way to represent missing or uncomputable values in code snippet and code snippet. The significance of percentage returns. Percentage returns are foundational in quantitative finance for several critical reasons. 1. Standardization and comparability. As demonstrated, they allow for a fair comparison of performance across assets with vastly different price scales. 2. Portfolio aggregation. Simple returns are additive across assets within a portfolio. This means the return of a portfolio is the weighted average of the simple returns of its individual assets. This property is crucial for portfolio construction and management. 3. Risk measurement. Returns are the primary input for calculating various risk metrics, such as volatility, standard deviation of returns, value at risk, VAR, and conditional value at risk, CVR. 4. Performance evaluation. All advanced performance metrics, including Sharpe ratio, Sortino ratio, and alpha, are built upon the concept of returns. They are essential for backtesting trading strategies and evaluating their historical profitability. Simple returns versus logarithmic returns, a forward look. While simple returns are widely used, especially for portfolio calculations and general reporting, another type of return, logarithmic returns, also known as continuously compounded returns, is prevalent in quantitative analysis, particularly for time series modeling and statistical analysis. Logarithmic returns are calculated as $RT /tech log equals \ln left frac right equals \ln st $ln where $ln denotes the natural logarithm. The key differences in SE cases are simple returns, preferred for calculating portfolio returns. They are additive across assets, and for clear interpretation as a percentage gain/loss over a period. Logarithmic returns, preferred when returns are aggregated over multiple periods. They are additive across time, unlike simple returns. They also have more desirable statistical properties, such as being more symmetrically distributed, which is beneficial for many statistical models and assumptions of normality. They are often used in academic research, option pricing models, and when dealing with high-frequency data. While simple returns are the focus of this section as the initial building block, understanding the existence and purpose of logarithmic returns is a valuable forward-looking concept for any aspiring quant trader. Working with dummy returns. In quantitative finance, understanding how to work with financial data is paramount. While real-world historical data is the ultimate source for analysis, using dummy or simulated data offers a powerful pedagogical tool. It allows us to isolate and focus on specific concepts, like the impact of volatility or the calculation of cumulative returns, without the complexities of data acquisition, cleaning, or market noise. This section will guide you through practical demonstrations of asset return analysis using simulated data, focusing on comparing mean returns, volatility, standard deviation, and cumulative asset values in Python with the Pandas library. Before we begin, ensure you have the necessary libraries installed and imported. Download the code on OnePageCode Substack. This initial block imports code snippet for efficient numerical operations, like mean calculation, code snippet for powerful data structuring and analysis, especially with data frames, and code snippet for creating static, interactive, and animated visualizations. We also include some optional code snippet configurations to enhance the visual appearance and readability of our plots throughout the section. Simulating asset returns. We'll start by defining two simple sets of dummy returns for two hypothetical assets, Asset 1 and Asset 2. These represent percentage changes over 5 consecutive periods. For instance, you can imagine these as 5 hypothetical monthly returns. Download the code on OnePageCode Substack. Here, code snippet represents a series of relatively consistent positive returns, suggesting a less risky asset. In contrast, code snippet shows larger fluctuations, including negative returns, which is indicative of a higher volatility asset. Initial comparison, mean return. A common first step in comparing investments is to look at their average, or mean, return. This gives us a quick sense of the typical return generated per period. Download the code on OnePageCode Substack. We use code snippet from the NumberPy library to compute the arithmetic mean for each list. Notice that both assets have the exact same average return of 0.03 or 3%. This immediately highlights a crucial point in investment analysis. The average return alone is insufficient for making informed investment decisions. While both assets yielded an average of 3% per period, their underlying return sequences are vastly different, hinting at differing risk profiles. Structuring returns with Panda's data frames. For more robust financial analysis, especially when dealing with multiple assets or time series data, Panda's data frames are indispensable. They provide a structured, labeled table that allows for efficient manipulation, statistical analysis, and visualization. Download the code on OnePatchCode Substack. We first create a standard Python dictionary where keys are the desired column names, e.g., Asset 1, and values are our lists of returns. Passing this dictionary to code snippet constructs our data frame. The code snippet output confirms that our columns are of code snippet data type. Code snippet is a 64-bit floating point number, which is the default and standard for numerical data in Pandas, providing sufficient precision for financial calculations. Visualizing period returns. Visualizing returns can quickly reveal patterns and differences that might not be obvious from raw numerical data. A bar chart is particularly effective for showing period-by-period returns and highlighting fluctuations. Download the code on OnePatchCode Substack. The code snippet method is a convenient way to generate a bar chart directly from the data frame. The code snippet, and code snippet parameters customize the plot's appearance. Adding code snippet helps to visually distinguish positive from negative returns. Observing this plot, it's immediately clear that Asset 2's bars fluctuate much more wildly, showing deeper dips and higher peaks than Asset 1's, visually confirming its higher volatility. This visual oscillation directly corresponds to a higher standard deviation. Quantifying volatility, standard deviation. While visual inspection is helpful, we need a quantitative measure for volatility. Standard deviation is a widely used metric in finance to quantify the dispersion or spread of returns around their mean. A higher standard deviation implies greater volatility and, consequently, higher risk. It tells us how much the individual data points typically deviate from the average. Download the code on OnePatchCode Substack. The code snippet method applied to a Pandas series, e.g., code snippet, calculates the standard deviation for that specific column. Similarly, code snippet can be applied directly to data frame columns or the entire data frame to get column-wise means. As expected from our visual inspection, Asset 2 has a significantly higher standard deviation, approximately 0.0768, compared to Asset 1, approximately 0.0148, quantitatively confirming its greater volatility and thus higher risk profile. Comprehensive statistics with code snippet. Pandas offers a powerful code snippet method that provides a quick statistical summary of numerical columns in a data frame. This includes key metrics like count, mean, standard deviation, minimum, maximum, and quartiles, 25th, 50th/median, and 75th percentiles. Download the code on OnePatchCode Substack. The code snippet method is incredibly useful for a rapid overview of your data's distribution. It immediately shows that while the code snippet for both assets is identical, 0.0300, Asset 2's code snippet, 0.0768, is much higher than Asset 1's, 0.0148. It also provides the minimum and maximum values, which further illustrate Asset 2's wider range of returns, reinforcing our observation that it is the more volatile asset. Calculating cumulative asset value. One of the most critical aspects of investment analysis is understanding how an initial investment grows over time. This requires calculating the cumulative value, which account for compounding. Compounding means that returns earned in one period also earn returns in subsequent periods, leading to exponential growth or decay. Step 1. Convert returns to growth factors. Percentage returns, code snippet, need to be converted into growth factors, code snippet, to represent the multiplier for an investment. For example, a 5% return means an investment grows by a factor of 1.05. A -3% return means it grows by a factor of 0.97. Download the code on OnePatchCode Substack. By adding code snippet to the code snippet, Pandas performs an element-wise operation, effectively adding code snippet to every single value in the data frame. This transforms each percentage return into its corresponding growth factor, which is essential for calculating compounded returns. Step 2. Manual cumulative value calculation, illustrative. Before using Panda's highly optimized code snippet function, let's understand the mechanics of cumulative value calculation. For a series of growth factors code snippet, the cumulative growth after code snippet periods is the product of all factors, code snippet. This process directly illustrates the concept of compounding. Download the code on OnePageCode Substack. This loop explicitly demonstrates how each period's growth factor multiplies the previous cumulative value, showing the compounding effect step by step. We start with an initial investment, e.g., $100, and multiply it by the successive growth factors for each period. Step 3. Efficient cumulative value with code snippet. Pandas provides a highly optimized method, code snippet, to compute the cumulative product along an axis. This is ideal for efficiently calculating cumulative returns from a series of growth factors, avoiding the need for explicit loops. Download the code on OnePageCode Substack. The code snippet method directly calculates the running product of the growth factors. The result shows how an initial unit of investment, represented by 1.0, would grow over time for each asset, assuming a starting value of 1.0. To get the actual asset value, representing the growth of a specific initial investment amount, we multiply these cumulative growth factors by that initial investment. Download the code on OnePageCode Substack. We multiply the code snippet data frame by code snippet. Again, Pandas performs this as an element-wise multiplication across the entire data frame, giving us the dollar value of our investment over time. Visualizing cumulative asset value. The most insightful visualization for comparing investment performance over time is a line chart of cumulative asset values. This chart directly illustrates the impact of compounding and volatility on terminal wealth. Download the code on OnePageCode Substack. The code snippet method generates a line chart, clearly showing the path of growth for each asset. Terminal value versus average return. Looking at the cumulative value chart. Both assets started at $100 and had the same average return of 3%. However, Asset 2, despite having the same average return as Asset 1, ends up with a lower terminal value, $103.01 versus $115.76. This is a critical lesson in quantitative finance. Average return alone is misleading. It does not account for the sequence of returns or the powerful effect of compounding. A few large negative returns early on can significantly dampen subsequent growth. Volatility destroys wealth. High volatility, large swings, both positive and negative, can significantly erode terminal wealth, even if the average return is high. This phenomenon is known as volatility drag or return drag. Consider a simple example. A minus 10% return followed by a plus 10% return does not bring you back to the original value. 0.901.10 is equal to 0.99, or a 1% loss. The more volatile an asset, the greater this drag can be over the long run. This simulation vividly demonstrates why risk volatility, as measured by standard deviation, is as important, if not more important, than just looking at average returns when evaluating investments over time. Investors seek not just high returns, but also a smooth growth path, or at least one where volatility does not excessively diminish their long-term gains. Further considerations. Log returns for multi-period analysis. While simple percentage returns are intuitive, log returns, also known as continuously compounded returns, are often preferred in academic, and quantitative finance for multi-period analysis, especially when summing returns or performing statistical tests. This is because log returns are additive over time, meaning the total log return for multiple periods is simply the sum of the log returns for each individual period. Download the code on OnePageCode Substack. Here, code snippet calculates the natural logarithm. The code snippet method computes the cumulative sum of the log returns. Notice that code snippet, the exponential function, can convert cumulative log returns back to simple cumulative growth factors, which should closely match the result from code snippet, demonstrating the equivalence and utility of log returns. Annualization of returns and volatility. If our dummy returns represented daily, weekly, or monthly periods, we would typically annualize them to compare them with common financial metrics, e.g., annual return, annual volatility. This standardizes performance across different frequencies. Annualized mean return, for simple returns code snippet. Annualized standard deviation, code snippet. For example, if our dummy returns were monthly and there are 12 months in a year, download the code on one PageCode Substack. These formulas allow us to scale period-specific metrics to an annual basis, making them comparable across different assets and timeframes, which is a common practice in financial reporting and analysis. Limitations of dummy data. While dummy data is excellent for learning and isolating concepts, it's crucial to remember its limitations for real-world applications. Real-world financial data is far more complex, exhibiting characteristics like non-normal distributions. Real returns often have fat tails, more extreme positive and negative events than a normal distribution would predict, and skewness. Autocorrelation, returns, and especially volatility, can exhibit dependencies over time, e.g., volatility clustering, where high volatility tends to be followed by high volatility. Market events, unexpected events, economic crises, geopolitical news, policy changes introduce sudden, large fluctuations not captured by simple random numbers. Transaction costs, liquidity, taxes. These practical factors significantly impact net returns, but are ignored in simple return calculations. This foundational understanding, however, is directly applicable when you transition to using real historical financial data, which is the next logical step in your quantitative finance journey. The principles of structuring data with data frames, calculating descriptive statistics, and visualizing performance remain the same, regardless of whether the data is simulated or real. This ability to simulate and analyze forms the bedrock for more advanced quantitative techniques, such as Monte Carlo simulations for portfolio risk assessment and scenario analysis. The 1+R format. Why 1+R? Understanding the format. In financial analysis, we often work with simple percentage returns, commonly denoted as code snippet. For instance, if a stock price moves from $100 to $105, the simple return is code snippet or 5%. While intuitive for individual period analysis, this format can become cumbersome for multi-period calculations or for certain vectorized operations across large datasets. The 1+R format, also known as the return multiplier or gross return, is simply the simple return plus 1. So, for 5% return, code snippet would be code snippet. This format represents the factor by which your initial investment grows over the period. If you invested $100 and the code snippet was 1.05, your new value would be code snippet. Mathematical relationship. Simple return, our $R equals \frac point pt $1 Viennas plus air format. Viennas dollars plus air lig. Viennas plus frat zt. Efte Viennas e. Te Viennas eliu. Frat. Efte Viennas e. Te Viennas plus frat ete. Efte Viennas e. Te Viennas eliu. Frat. Ete te Viennas. This final simplification, $1+R equals \frac point pt $, is crucial. It shows that the 1+R format is simply the ratio of the current price to the previous period's price. This direct ratio makes it highly efficient for computational purposes, especially when dealing with large time series of prices. Let's illustrate with a small, concrete example. Period price, P, simple return, R, 1+R format. Day 0, $100. Day 1, $105, $105 to 100. /100 equals 5 cents, $105 /100 equals $1.05. Day 2, $102.90, 102.90 to 105 slash 105 equals negative 2 cents. $102.90 slash 105 equals 98 cents. Day 3, $108.05. 108.05 to 102.90 slash 102.90 equals 5 cents. 108.05 slash 102.90 equals $1.05. As you can see, the code snippet column directly represents the factor by which the price changed from the previous day. A value greater than 1.0 indicates a gain, while a value less than 1.0 indicates a loss. The power of vectorization. Computational efficiency. One of the primary reasons the code snippet format is favored in quantitative finance is its compatibility with vectorized operations. Vectorization is a programming paradigm where operations are applied to entire arrays or series of data at once, rather than element by element using explicit loops. Libraries like NumPy and Pandas in Python are highly optimized for vectorized computations, leveraging underlying C or Fortran implementations for significant speed improvements. Consider calculating returns for a time series of 100,000 prices. A traditional code snippet loop approach would iterate through each price, perform the subtraction and division, and store the result. While conceptually simple, this is computationally inefficient in Python because the loop overhead adds significant time, especially for large data sets. Instead, vectorized operations allow us to perform the entire calculation, code snippet, on two entire series of prices simultaneously. This means that instead of telling the computer to take the first price, div, divide it by the previous price, then take the second price, divide it by its previous price, and so on, we can simply tell it, take this entire series of prices and divide it by this other entire series of prices, which is just the first series shifted. The underlying optimized code handles the element-wise division extremely rapidly. The code snippet format naturally lends itself to this because it's a simple division of two price series. If we were to calculate simple returns, code snippet, it would involve a subtraction and a division. While still vectorized, the code snippet format highlights the core ratio calculation that is very efficient. More importantly, when compounding returns over multiple periods, multiplying code snippet values is far simpler and computationally faster than adding simple returns. Calculating 1+ are returns with Pandas. Pandas, a fundamental library for data analysis in Python, provides powerful tools for time series manipulation, including the code snippet method, which is essential for calculating returns. The code snippet method moves data points forward or backward along an axis, creating the code snippet series we need. Let's walk through the process step by step with code. First, we need to import code snippet and create a sample data frame representing asset prices over time. Download the code on OnePageCode Substack. This code block initializes our environment by importing the necessary libraries and constructing ASM, all representative data frame. The code snippet simulates daily closing prices for an asset, starting around 100 and exhibiting some random fluctuations. This setup allows us to demonstrate return calculations on realistic-looking data. Next, we'll use the code snippet method to get the previous day's closing prices. Download the code on OnePageCode Substack. Here, code snippet creates a new column code snippet. The code snippet operation moves each value in the code snippet column down by one row. This means that for any given row code snippet will contain the code snippet price from row code snippet. Notice that the very first row's code snippet will be code snippet, not number, because there is no prior data point to shift into that position. This code snippet is a common occurrence when calculating returns and needs to be handled. Now, we can calculate the code snippet returns by dividing the current code snippet price by the code snippet price. Download the code on OnePageCode Substack. This step directly applies the formula code snippet using vectorized division across the code snippet and code snippet columns. The result is the code snippet return for each period. As expected, the first value in the code snippet column is also code snippet because its numerator, code snippet at index 0, is divided by code snippet at index 0. If you need to convert back to simple percentage returns code snippet, It's a straightforward subtraction of 1. Download the code on one patch code Substack. This line demonstrates the ease of converting from the code snippet format back to the more commonly understood simple percentage return code snippet. This flexibility allows you to use the most computationally efficient format for calculations and then convert to a more human-readable format for reporting or analysis. Finally, let's address the code snippet values. The code snippet in the first row is a natural consequence of return calculation. You can't calculate a return without a previous price. For most analyses, you'll want to remove these rows. Download the code on one patch code Substack. The code snippet method removes any rows where the code snippet column contains a code snippet. This is a crucial step before performing statistical analysis or further calculations on the returns, as code snippet values can propagate errors or lead to incorrect results in many functions. Alternatively, depending on the context, one might code snippet or use a different imputation strategy, but code snippet is common for returns. Common pitfalls and best practices. Handling code snippet values. Always be mindful of the code snippet value that results from the code snippet operation. For most return series, the common practice is to drop this initial code snippet using code snippet. Failing to do so can lead to errors in subsequent calculations, e.g., sum, mean, standard deviation. Data alignment. Pandas vectorized operations automa. Tcali handle data alignment based on the data frames index. This is a powerful feature, but it means your time series data must have a proper, unique, and sorted datetime index for code snippet and other time series operations to work as expected. Choosing the right format. While code snippet is excellent for compounding returns by multiplication and vectorized operations, code snippet, simple percentage return, is often more intuitive for understanding single-period performance or for calculating average returns. Use code snippet for internal computations and transformations, and convert to code snippet for reporting or when an additive structure is required, e.g., for calculating standard deviation of returns. Log returns versus simple returns. For more advanced analyses, particularly in academic finance or for very short time horizons, log returns, code snippet, are often preferred due to their additive properties and nicer statistical characteristics. However, for most practical trading applications and backtesting, simple returns or the code snippet format are sufficient and more directly interpretable in terms of capital growth. The terminal return. The terminal return, often denoted as code snippet, represents the total percentage change in an investment's value from its initial point, code snippet, to its final point, code snippet, over a specified period. It provides a single, aggregate measure of performance, telling you how much your investment has grown or shrunk overall, expressed as a percentage. This metric is fundamental for understanding long-term investment outcomes, especially for buy-and-hold strategies. Calculating terminal return from initial and final prices. The most straightforward way to calculate the terminal return is by comparing the final value of an investment to its initial value. The formula is code snippet. This can be simplified to code snippet, where code snippet is the initial price or value of the investment. Code snippet is the terminal, final price or value of the investment at the end of the period code snippet. Let's illustrate this with a simple numerical example. Suppose you invest $100 in an asset, and after a year, its value grows to $120. Code snippet, code snippet, code snippet, or 20%. This means your investment yielded a 20% total return over the period. We can apply this concept directly using Python. Let's assume we have an initial investment amount and a final value for an asset. Download the code on one patch code Substack. This code snippet demonstrates the most intuitive way to compute terminal return, a direct comparison between the STA, rooting, and ending values. This method is particularly useful when you only have access to the initial and final prices of an asset, or when assessing the performance of a portfolio over its entire lifespan without needing to delve into intermediate price movements. Calculating terminal return by compounding periodic returns. While calculating terminal return from initial and final prices is simple, in financial analysis, We often work with a series of periodic returns, e.g., daily, monthly, or annual returns. The terminal return can also be derived by compounding these individual periodic returns. This method highlights the power of compounding over time. Recall from the 1 plus our format section that we transform periodic returns code snippet into code snippet format to facilitate compounding. If code snippet are the returns for successive periods, the cumulative growth factor over code snippet periods is the product of all code snippet terms. Code snippet. The terminal return code snippet is then obtained by subtracting 1 from this cumulative growth factor. Code snippet. Numerical example, tracing compounding. Let's trace this with a simple 3-period example. Assume an initial investment of $100 and the following periodic returns. Period 1 are 0, 1 plus 10%. Period 2 are 1, 2 plus 5%. Period 3 are 2, 3 minus 2%. Step-by-step calculation. 1. Initial value, S0 $100. 2. Value after period 1, S1 code snippet. 3. Value after period 2, S2 code snip. 4. Value after period 3, S3 code snippet. So, the terminal price code snippet, which is code snippet in this case, is $113.19. Now, let's calculate the terminal return using the initial/final price method. Code snippet or 13.19%. Next, let's calculate the terminal return by compounding the code snippet factors. Code snippet, code snippet, code snippet, code snippet, code snippet or 13.19%. As you can see, both methods yield the exact same terminal return. This numerical example clearly illustrates the equivalence, mathematical equivalence of the two methods. The two methods for calculating terminal return are mathematically equivalent. This can be shown by expanding the compounding formula. Code snippet. Let code snippet represent the product of all individual code snippet terms. Then, code snippet. From this, we could derive code snippet. Code snippet. And since code snippet is our code snippet, the terminal return from compounding, we have code snippet. This derivation explicitly demonstrates why compounding periodic returns in code snippet format, and then subtracting 1 is equivalent to simply taking code snippet. Both methods essentially measure the same total relative change. Python implementation with compounding. In previous sections, we worked with a data frame of periodic returns, code snippet, and derived a code snippet data frame, which represented the cumulative value of an initial investment over time. We can leverage these to calculate the terminal return. Let's recreate a sample code snippet and code snippet for demonstration, assuming in code snippet of $100. Download the code on OnePageCode Substack. The code snippet data frame holds the theoretical value of our initial investment at each point in time, given the periodic returns. The last row of code snippet represents the terminal value, code snippet, for each asset. Now, we can calculate the terminal return for each asset using the code snippet data frame's final row and our code snippet. Download the code on OnePageCode Substack. This method connects directly to the code snippet function used previously. The code snippet gives us the final asset price, code snippet, and dividing by code snippet, our code snippet, and subtracting 1 gives the terminal return. Alternatively, we can directly compute the product of all code snippet terms from the code snippet using the code snippet method, which is a convenient way to get the cumulative product for the entire period. Download the code on OnePageCode Substack. The code snippet method on a pandas series or data frame performs a product aggregation, making it ideal for compounding returns over an entire period. This code chunk demonstrates the most direct and computationally efficient way to calculate the terminal return from a series of periodic returns in Python. The output code snippet confirms that both methods yield practically identical results, reinforcing their mathematical equivalence. Understanding the context ND limitations of terminal return. While the terminal return is a powerful metric for assessing overall investment growth, it's crucial to understand its specific applications and inherent limitations. Synonyms and distinctions. In common financial parlance, terminal return is often used interchangeably with total return or cumulative return. All these terms generally refer to the aggregate percentage change in an investment's value over its entire holding period from start to finish. There are no subtle distinctions in their core meaning. They all describe the same concept of overall growth or loss. Appropriate scenarios for terminal return. Terminal return is the most appropriate metric in several key scenarios. 1. Long-term buy and hold strategies. For investors who purchase an asset and hold it for an extended period, e.g., several years or decades. Without frequent trading, the terminal return provides a clear picture of the investment's success over its entire lifespan. 2. Overall portfolio performance. It's used to assess the total growth of an investment portfolio from its inception to a specific reporting date. 3. Performance reporting. Investment funds, mutual funds, and other financial products frequently report total return over various periods, e.g., 1 year, 5-year, 10-year, or inception to date, to show their cumulative performance to investors. This total return is essentially the terminal return for that specific period. 4. Foundation for CAGR. As we'll explore in the next section, the terminal return is a necessary component for calculating the compound annual growth rate, CAGR, which annualizes this total return. Limitations. What terminal return does not tell you. While valuable, terminal return provides a simplified view of performance. It does not provide insights into 1. Volatility or risk. The terminal return only considers the start and end points. It completely ignores the journey taken to get there. Two assets could have the exact same terminal return, but vastly different intermediate price paths and risk profiles. Why this is a limitation? An investor might prefer an asset with smooth, consistent growth over one that experiences wild swings, high volatility, even if both end up with the same total return. High volatility often implies higher risk and can be psychologically taxing or lead to forced-selling during downturns. 2. Path dependency. It doesn't reveal how the investment performed at different points in time or how frequently it experienced drawdowns, periods of decline from a peak. Let's consider a hypothetical example to illustrate the limitation regarding volatility. Download the code on OnePageCode Substack. In this example, both asset A and asset B start at $100 and end at $150, resulting in an identical terminal return of 50%. However, a glance at their price paths clearly shows asset A experienced smooth, steady growth, while asset B had significant fluctuations, including period S of decline, before reaching the same terminal value. An investor's experience and perceived risk would be vastly different between these two assets, even with the same terminal return. This highlights why other metrics, such as volatility measures, e.g., standard deviation of returns, are necessary for a complete risk-adjusted performance assessment. Relationship with compound annual growth rate, CAGR. The terminal return is a direct input for calculating the compound annual growth rate, CAGR. While terminal return gives you the total growth over any period, CAGR annualizes this growth, providing a smoothed average annual rate of return over a specified number of years. The formula for CAGR is code snippet, where code snippet is the number of years. Understanding terminal return is therefore a prerequisite for grasping and calculating CAGR, a widely used metric for comparing investments over different time horizons. We will delve into CAGR in detail in a subsequent section. Stock return with dividends. When evaluating the performance of a stock investment, it's critical to distinguish between different measures of return. While the most intuitive measure, code snippet, captures only the change in the stock's market price, a more comprehensive and accurate measure is the code snippet, which also accounts for income generated from dividends. Understanding price return versus total return. Code snippet, also known as capital appreciation, measures the percentage change in a stock's price over a specific period. It is calculated simply as $text price return equals /frac $1 $1, where code snippet is the stock price at the end of the period. Code snippet is the stock price at the beginning of the period. While useful for understanding capital gains, code snippet tells only part of the story. Many companies distribute a portion of their earnings to shareholders in the form of code snippet. For investors, especially those focused on income or long-term wealth accumulation, these dividends are a significant component of their overall return. Ignoring them would lead to an incomplete and often misleading assessment of an investment's true performance. Code snippet provides a holistic view by including both the capital appreciation and any dividends received during the investment period. It represents the actual profit an investor realizes from holding a stock. The total return formula. The formula for calculating the total return for a stock over a given period is $text total return equals \frac TST 1 plus DT 1 to $1. Let's break down each component of this formula. Code snippet. This represents the stock price at the end of the period. It's the selling price if you were to liquidate your position. Code snippet. This is the stock price at the beginning of the period. It's your initial cost basis for the stock. Code snippet. This represents the cash dividends paid per share during the period from code snippet to code snippet. It's crucial to note that this typically refers to cash dividends, not stock dividends, which are shares of stock instead of cash. The timing of the dividend payment is important. It must have been paid and received by the shareholder within the defined period. The numerator, code snippet, calculates the total monetary gain from the investment, combining both price appreciation and dividend income. Dividing this by the initial price, code snippet converts this monetary gain into a percentage return, making it comparable across different investments. Step-by-step calculation example. Let's walk through a concrete example to solidify understanding. Scenario. Suppose you bought a stock at the beginning of the year for code snippet. At the end of the year, its price is code snippet. During the year, the company paid a cash dividend of code snippet per share. 1. Identify the variables. Code snippet beginning price equals code snippet. Code snippet ending price equals code SN. IPIT. Code snippet dividends paid equals code snippet. 2. Calculate price return. $text price return equals \frac T equals \frac $105 $100 $100 equals \frac $5 $100 equals 0.05 equals 5 %. Based solely on price, the stock yielded a 5% return. 3. Calculate total return. $text total return equals \frac T 1 plus D 1 T equals \frac $105 $100 plus $2 $100 equals \frac $7 $100 equals 0.07 equals 7 %. By including the dividend, the true return on the investment is 7%, which is significantly higher than the 5% price return. This difference highlights why total return is a superior metric for comprehensive investment analysis. Implementing total return in Python. We will use the code snippet library to manage our financial data, as it provides powerful tools for handling time series and tabular data efficiently. First, let's import code snippet and create a simple data frame to simulate our stock price and dividend data. Download the code on OnePageCode Substack. This initial code block sets up our environment by importing code snippet and then creating a code snippet named code snippet. This data frame contains 2 columns: code snippet, simulating stock prices at different dates, and code snippet, representing cash dividends paid on those dates. We've used code snippet to create a code snippet, which is standard practice for financial time series data. The code snippet statement allows us to inspect the raw data. Next, we'll calculate the code snippet using the code snippet method, which is highly efficient for calculating percentage changes between consecutive elements in a series. Download the code on OnePageCode Substack. Here, we add a new column, code snippet, to our code snippet data frame. The code snippet method computes the percentage change between the current row's price and the previous row's price. The first value will be code snippet because there's no preceding price to compare against. Now, let's calculate the code snippet. According to the formula, we need the beginning price, ending price, and dividends paid during the period. For a daily or period-over-period total return, the dividend code snippet is the dividend paid at time code snippet, or effectively received at code snippet for the period ending at code snippet. Download the code on one patch code Substack. This block is the core of our total return calculation. 1. We first create a code snippet column using code snippet. This aligns the price from the previous period with the current period, which is essential for the denominator code snippet in our formula. 2. Next, code snippet is calculated by dividing the code snippet paid in the current period by the code snippet. This represents the dividend's contribution to the return relative to the initial investment. 3. Finally, code snippet is computed by adding the code snippet, which is code snippet, and the code snippet, code snippet. This effectively implements the code snippet formula. Note the code snip T values for the first row as there's no prior period to calculate returns. Also, periods without dividends will simply have a code snippet of 0, meaning code snippet will equal code snippet for those periods. Handling real-world data considerations. In real-world scenarios, obtaining accurate historical price and dividend data is crucial. Data acquisition. Reliable financial data providers, e.g., Yahoo Finance, Quandl, Bloomberg, Refinitiv Icon, Capital IQ, are the primary sources for historical stock prices and dividend records. These providers often offer data in formats easily ingestible by Python libraries. Missing dividends. It's common for stocks not to pay dividends every period. Our current code naturally handles this. If code snippet is code snippet or code snippet for a given period, the code snippet will also be code snippet or code snippet, correctly resulting in the code snippet equaling the code snippet for that period. Code snippet values in code snippet would propagate to code snippet for that period, indicating missing information. It's often best practice to code snippet for dividend columns if you are certain that code snippet implies no dividend was paid, rather than truly missing data. Download the code on one patch code Substack. This segment addresses a common data cleaning step. While our initial dummy data explicitly uses code snippet for periods without dividends, real datasets might have code snippet values. If a code snippet in the dividend call truly means no dividend was paid, then code snippet is an appropriate step to ensure calculations proceed correctly. We create new columns code snippet and code snippet to demonstrate this potential cleaning impact. Practical importance and insights. The distinction between price return and total return is not merely academic. It has significant practical implications for investment analysis and decision-making. Accurate performance assessment. Total return provides the most accurate picture of an investment's profitability. An asset might show modest price appreciation, but delivers strong total returns due to consistent dividend payments. Comparing investment strategies. For an income-oriented investor, code snippet is paramount. Comparing a growth stock, which typically pays no or low dividends, with a value or income stock, which often pays significant dividends, solely on code snippet would be misleading. The income stock's true contribution to the investor's portfolio might be substantially higher when dividends are included. Reinvestment impact. While our formula calculates total return for a single period, in practice, dividends can often be reinvested to purchase more shares. This code snippet leads to compounding returns, significantly boosting long-term wealth accumulation, a concept often referred to as code snippet. While the simple total return formula does not explicitly model reinvestment, it sets the foundation for understanding this powerful effect. Adjusted prices. Financial data providers often offer code snippet or code snippet. These prices are reverse engineered to account for dividends, such that the simple percentage change in these adjusted prices directly reflects the total return. This is a common shortcut for analysts, but understanding the underlying calculation helps in situations where raw price and dividend data are preferred or necessary for custom analysis. By consistently using code snippet in your analysis, you gain a clearer, more complete understanding of investment performance enabling more informed and robust financial decisions. Multi-period return. Understanding investment performance over a single period, such as a day, month, or year, is fundamental. However, investments typically span multiple periods. The multi-period return measures the cumulative performance of an investment over several consecutive periods, accounting for the powerful effect of compounding. It answers the question, if I invested $1 at the beginning of a multi-period interval, how much would it be worth at the end, considering all the gains and losses along the way? The principle of compounding. The core concept behind multi-period return is compounding. Compounding refers to the process where the earnings from an investment are reinvested, leading to future earnings being generated not only on the initial principal, but also on the accumulated interest or returns from previous periods. This creates a snowball effect, where returns generate further returns. Consider an investment that earns 10% in the first year and 5% in the second year. Year 1. An initial investment of $100 grows by 10%, becoming $100. 1 plus 0.10 equals $110. Year 2. The 5% return in the second year is applied to the new base of $110, not the original $100. So, the investment grows by 5% of $110, which is $110. 0.05 equals $5.50. The total value becomes $110 plus $5.50 equals $115.50. If we were to simply add the returns, 10% plus 5% equals 15%, we would incorrectly conclude the investment grew to $115, $100 1.15. The difference of 50 cents, $115.50 to $115, is the return on the FIRS. T-year's earnings, $10 0.05 equals 50 cents. This seemingly small difference can become substantial over many periods and with larger sums. Why simple summation is incorrect? Simply adding single-period returns, e.g., 10% plus 5% equals 15%, is incorrect for calculating multi-period returns because it ignores the changing base value of the investment. Each period's return is applied to the ending value of the previous period, not the initial principal. This fundamental principle is why the code snippet format, introduced in previous sections, is crucial for accurate multi-period calculations. Calculating multi-period return, the code snippet format. To correctly calculate multi-period return, we use the code snippet format, which represents the growth factor for each period. If code snippet are the single-period returns for code snippet consecutive periods, the multi-period return, code snippet, is calculated as code snippet, and therefore, code snippet. This formula is equivalent to calculating the geometric mean of the code snippet values, and then transforming it back into a return. The geometric mean is the appropriate average for quantities that are multiplied together, such as growth rates or returns, as it accurately reflects the compound effect. In contrast, the arithmetic mean, simple average, is suitable for quantities that are summed. Practical calculation in Python. Let's demonstrate how to calculate multi-period returns using Python, leveraging the code snippet library for EFIC. INT array operations. First, we'll import code snippet and define a sample series of single-period returns. Download the code on OnePageCode Substack. The code snippet array above represents the percentage change for each day. For example, code snippet means a 0.5% gain, and code snippet means a 0.2% loss. The incorrect method, simple summation. Before showing the correct approach, let's illustrate the common pitfall of simply summing returns. Download the code on OnePageCode Substack. This output provides a summed return, which does not account for compounding. If the returns were small and the period short, the difference might be negligible, but it's fundamentally flawed for accurate financial calculations. The correct method, compounding with code snippet. The correct approach involves converting each return into its code snippet format and then multiplying these growth factors together. Code snippet is ideal for this. Download the code on OnePageCode Substack. Each value in code snippet represents how much $1 would become after that specific period. For example, code snippet means $1 becomes $1.005. Download the code on OnePageCode Substack. The code snippet tells us that $1 invested at the beginning would be worth approximately $1.0159 at the end of these 5 periods. Download the code on OnePageCode Substack. This final value, code snippet, represents the true compounded return over the entire series of periods. Let's compare the incorrect simple sum with TH. Correct compounded return. Download the code on OnePageCode Substack. As seen, there's a difference even for small daily returns. Over longer periods and with larger returns or losses, this difference can be substantial. Illustrative example with more periods. Let's apply this to a slightly longer series, perhaps representing annual returns over several years. Download the code on OnePageCode Substack. This shows that an investment experiencing these annual returns would have yielded a compounded return of approximately 33.64% over 5 years. Multi-period returns for sub-periods, trailing returns. Often, analysts are interested in trailing returns, which are multi-period returns calculated over a fixed historical window, e.g., trailing 3-month, 1-year, 5-year returns. These are commonly reported by financial institutions. We can calculate these by slicing our series of code snippet values. Let's use a code snippet to make slicing by date easier, assuming we have daily returns. Download the code on OnePageCode Substack. Now, let's calculate the multi-period return for specific windows, for example, the first 3 days and the last 5 days. Download the code on OnePageCode Substack. This demonstrates how to isolate specific periods within a longer time series and calculate their compounded returns. Multi-period return versus terminal return. The concept of terminal return, discussed in a previous section, is essentially a specific instance of a multi-period return. Tamina, L return measures the total compounded return from the initial investment point to a specific terminal point. It is the multi-period return calculated over the entire available history of an investment. The code snippet function, which was used in the context of terminal return and code snippet, is deeply related to multi-period returns. Code snippet inherently calculates the compounded value up to each point in a series of code snippet values. Download the code on OnePageCode Substack. Each element in code snippet represents code snippet. For example, the value at index code snippet is code snippet. This means that if you want the multi-period return from the start of the series to any point code snippet, you simply take code snippet. Multi-period return versus arithmetic average return. It's crucial to understand the distinction between multi-period return, which is based on the geometric mean, and the arithmetic average return, simple average. Multi-period return, geometric average return, this is the actual compound growth rate of an investment over multiple periods. It tells you the single constant rate that, if applied each period, would result in the same total compounded growth as the variable returns actually experienced. It is appropriate when you want to know the actual wealth accumulation or the true average growth rate of an investment. Arithmetic average return. This is the simple average of the single period returns. Code snippet. It is useful for understanding. G, the average return per period without considering compounding. It is often used for statistical analysis, such as calculating the expected return of a portfolio or estimating the volatility of returns. However, it does not represent the actual growth of wealth over time. Consider the following example. Year 1, plus 100% value doubles. Year 2, minus 50% value halves. Download the code on OnePageCode Substack. In this example, the arithmetic average is 25%, which might suggest positive performance. However, the multi-period return is 0%, meaning the investment ended up exactly where it started, e.g. $100-$200-$100. This clearly illustrates why the multi-period geometric return is the correct measure for actual wealth accumulation. The arithmetic mean will almost always be higher than the geometric mean for a series of returns, unless all returns are identical. Common pitfalls and best practices. 1. Always use code snippet for compounding. Never sum returns directly from multi-period calculations. Always convert to code snippet factors and multiply. 2. Distinguish return types. Be clear whether you need the actual compounded growth, multi-period/geometric, or simple average, arithmetic, for statistical purposes. 3. Data consistency. Ensure the periods of your returns are consistent, e.g., all daily, all monthly, all annual. Mixing different frequencies without proper conversion will lead to incorrect results. 4. Missing data. Handle missing return data appropriately, e.g., by skipping those periods or by interpolating if justifiable, though this is rare for returns. 5. Annualization. For multi-period returns that span less than a year, e.g., 3-month return, or to compare returns over different periods, you might need to annualize them. This involves converting the multi-period return to an equivalent annual rate, often by raising code snippet to the power of code snippet. This concept will be explored in more detail in a later section. Real-world application. Multi-period returns are ubiquitous in finance. Investment performance reporting. Fund managers, brokers, and investment advisors routinely report trailing multi-period returns, e.g., 1-year, 3-year, 5-year, 10-year, and inception-to-date returns for mutual funds, ETFs, and individual portfolios. These figures allow investors to assess long-term performance and compare different investment vehicles. Performance benchmarking. Investors compare the multi-period returns of their portfolios against relevant benchmarks, e.g., S&P 500 index, over the same periods to evaluate relative performance. Financial modeling. When projecting future portfolio values or analyzing historical growth trends, multi-period returns are essential inputs. Risk management. Understanding compounded returns helps in assessing the impact of drawdowns and recoveries over extended periods. Annualizing returns. The need for standardization. Comparing investment performance across different time horizons is a common challenge for investors and traders. A stock might return 0.1% in a day, while a bond fund yields 5% over a year, and a private equity fund boasts 15% over 5 years. How do you compare these? The answer lies in annualizing returns. Annualization is the process of converting a return from any period, e.g., daily, monthly, quarterly, into an equivalent annual return, allowing for a standardized, apples-to-apples comparison. The pitfall of simple multiplication. A common mistake when trying to standardize returns is to simply multiply the periodic return by the number of periods in a year. For instance, if a stock gains 0.1% in a day, one might mistakenly assume its annual return is code snippet. This approach is fundamentally flawed because it ignores the principle of compounding. Compounding means that the returns generated in one period also earn returns in subsequent periods. If you earn 0.1% today, that 0.1% is added to your principal, and tomorrow's 0.1% return is calculated on this new, larger principal. Simple multiplication fails to account for this exponential growth. Let's illustrate this with code. Download the code on OnePageCode Substack. This initial code snippet sets up our daily return and the number of trading days. It then calculates the annual return using the incorrect simple multiplication method. As seen, this method suggests a 25.2% annual return. The compounding annualization formula. The correct way to annualize a return involves applying the power of compounding. We leverage the code snippet format, which represents the growth factor for a given period. If a periodic return is code snippet, then the growth factor for that period is code snippet. To find the growth factor over multiple periods, we raise this factor to the power of the number of periods. The general formula for annualizing a periodic return is $text annualized return equals 1 plus \text periodic return \text number of periods per year $1. Let's break down the components. Code snippet. The return earned over a specific period, e.g., daily, monthly, quarterly. Code snippet. How many of these specific periods fit into 1 year? Here are common values for code snippet. Daily returns, typically 252, representing trading days in a year. Sometimes 365 for calendar days, though less common for financial assets. Weekly returns, 52. Monthly returns, 12. Quarterly returns, 4. Semi-annual returns, 2. Now, let's use the correct formula in Python. Download the code on OnePageCode Substack. Comparing this output to the simple multiplication, we see a significant difference. The compounded annual return is higher, reflecting the effect of earning returns on previously earned returns. For a 0.1% daily return, the compounded annual return is approximately 28.69%, significantly more than 25.2%. This difference underscores the importance of correctly accounting for compounding. We can encapsulate this logic into a reusable function. Download the code on OnePageCode Substack. This function code snippet provides a clear and reusable way to perform the annualization calculation, making our code modular and easy to understand. Applying annualization to different periodicities. Let's demonstrate how to use our code snippet function for various periodicities. Example: annualizing a monthly return. Suppose an investment generates a consistent 1.5% return every month. Download the code on OnePageCode Substack. A seemingly modest 1.5% monthly return, when compounded over a year, translates to a robust 19.56% annualized return. Example: annualizing a quarterly return. Consider a fund that reports a 3% return each quarter. Download the code on OnePageCode Substack. A 3% quarterly return, compounded, results in a 12.55% annualized return. Comparative analysis. By annualizing these different periodic returns, we can now compare them on a standardized basis. 0.1% daily return $/RITERO 28.69% annualized. 1.5% monthly return $/RITERO 19.56% annualized. 3% quarterly return $/RITERO 12.55% annualized. This highlights the power of annualization. It allows us to objectively compare the performance of investments regardless of their reporting frequency. Annualizing a series of historical returns. The code snippet function we've developed is ideal for annualizing a single, given periodic return that is assumed to be constant. However, in real-world scenarios, we often deal with a series of historical returns, e.g., daily returns for a year or monthly return for several years. Annualizing a series of historical returns requires a slightly different approach, as we first need to calculate the total cumulative return over the period and then annualize that total return. This is often done using the geometric mean. Let's import code snippet for handling time series data, which is common in finance. Download the code on OnePageCode Substack. We import code snippet for its powerful code snippet and code snippet objects, and code snippet for general numerical operations, which will be useful for calculating geometric means. Annualizing a series of daily returns. To annualize a series of daily returns over a specific period, e.g., 1 year, we first calculate the cumulative product of code snippet over that period. This gives us the total growth factor. Then we annualize this total growth factor. Download the code on OnePageCode Substack. This code simulates a series of 252 daily returns. In a real scenario, this code snippet would be loaded from a CSV or database. Now, we calculate the total cumulative return over the period and then annualize it. Download the code on OnePageCode Substack. Here, we calculate the code snippet by multiplying all code snippet terms. Since our simulated series covers exactly code snippet periods, the code snippet calculation EFF actively simplifies to just code snippet. This method is robust, even if the series doesn't cover exactly 1 year. For instance, if you had 100 daily returns, code snippet would be 100 and the formula would correctly project to an annual rate. Annualizing a series of monthly returns. The same principle applies to monthly or any other periodic series. Download the code on OnePageCode Substack. This example shows how to annualize a series of 12 monthly returns. The formula naturally handles the geometric compounding over the entire period before converting it to an annual rate. This approach is equivalent to calculating the geometric mean return per period and then annualizing that, but it's often more intuitive as it directly works with the total growth factor. Considerations and limitations. While annualizing returns is a powerful tool for comparison, it's crucial to understand its underlying assumptions and limitations. Assumption of constant periodic return. For single periodic return annualization, when annualizing a single periodic return, e.g., if this stock keeps returning 0.1% daily. The formula assumes that this rate is maintained consistently for the entire year. This is rarely the case in volatile financial markets. Historical data versus forecasts. When annualizing a series of historical returns, the result represents the average annual performance over that historical period. It is not a guarantee or forecast of future returns. Past performance is not indicative of future results. Short periods and volatility. Annualizing returns from very short periods, e.g., a single day or week, can lead to extremely high or low annualized figures if the initial periodic return is unusually large or small. For instance, a 10% return in one day would annualize to an astronomical figure, which is highly unrealistic to sustain. Such annualized figures from short, volatile periods should be interpreted with extreme caution and are generally not reliable predictors of long-term performance. Time horizon. The relevance of an annualized return depends on the investment horizon. For long-term investments, annualized returns over several years, using geometric mean, are highly relevant. For short-term trading strategies, daily or weekly returns might be more pertinent than annualized figures, though annualization still helps in comparing strategy effectiveness over time. Cash flows. The simple annualization formula assumes no withdrawals or additions to the principal during the period. For portfolios with complex cash flows, more sophisticated methods like time-weighted return, TWR, or money-weighted return, MWR, are used to calculate performance, which can then be annualized. Understanding these nuances ensures that annualized returns are used as an informative metric for comparative analysis, rather than a definitive prediction or an oversimplified representation of complex financial performance. Calculating single-period returns from price data. Understanding and accurately calculating single-period returns is a fundamental skill in quantitative finance. These returns serve as the basic building blocks for almost all subsequent financial analyses, from measuring volatility and risk-adjusted performance to constructing portfolio strategies and backtesting. While previous sections introduced the theoretical concept of total return and the code snippet format, this section focuses on the practical computational methods for deriving these returns from raw price data using Python. The single-period return formula. At its core, a single-period return measures the percentage change in an asset's price over a specific interval. For a given period code snippet, if code snippet is the price at the end of the period and code snippet is the price at the beginning of the period, the return code snippet is calculated as $RT equals \frac st 1 This formula can also be expressed in terms of the code snippet format, which is particularly useful for compounding returns. $1 plus RT equals \frac st $1. Therefore, $RT equals \frac st $1. Both forms are equivalent and will be demonstrated in the computational examples. Let's use a small, relatable series of hypothetical stock prices for TechCorp Incorporated code snippet to illustrate these calculations. Download the code on OnePageCode Substack. The code snippet list represents the closing prices of TechCorp Incorporated over 6 consecutive periods, e.g. days. Our goal is to calculate the daily return for each period. Manual calculation with Python lists. While not efficient for large data sets, Starting with a manual calculation using basic Python lists helps solidify the understanding of the return formula. We will iterate through the list, taking 2 consecutive prices at a time. Download the code on OnePageCode Substack. This loop explicitly applies the return formula for each period, starting from the second price point, Index 1, to ensure we always have a code snippet. The result is a list of percentage changes. This method, however, becomes cumbersome and slow for large datasets. Vectorized operations with NumPy arrays. For efficiency and performance, especially with large financial datasets, code snippet is indispensable. It allows for vectorized operations, meaning operations are applied to entire arrays at once, rather than element by element in a Python loop. This is significantly faster because the underlying operations are implemented in optimized C code. First, let's convert our price list into a NumPy array. Download the code on OnePageCode Substack. Now, we can leverage NumPy's array slicing to obtain the current prices, code snippet, and lag prices, code snippet, as separate arrays. Download the code on OnePageCode Substack. Notice how code snippet and code snippet are now aligned such that the first element of code snippet corresponds to the price following the first element of code snippet. This alignment is crucial for correct calculation. With the arrays aligned, we can perform the vectorized division to get the code snippet format, and then subtract 1 to get the returns. Download the code on OnePageCode Substack. This approach is significantly more performant than the manual loop, especially as the number of price points increases. Working with Pandas data frames. Code snippet is built on top of code snippet and provides powerful data structures, particularly code snippet and code snippet, which are ideal for handling financial time series data. Data frames offer labeled axes, index, and columns, making data manipulation intuitive and robust. Let's convert our TCI prices into a Pandas data frame. Download the code on OnePageCode Substack. The data frame automatically assigns a numerical index, 0, 1, 2. For financial data, this index often represents dates or timestamps, which provides additional context and functionality. Subsetting with code snippet. Similar to NumPy array slicing, Pandas data frames can be subset. The code snippet indexer allows for integer location-based indexing, behaving much like NumPy array indexing. Download the code on OnePageCode Substack. While code snippet successfully extracts the desired subsets, directly performing arithmetic operations on these data frames can lead to issues if their indices do not perfectly align. Pitfall: Pandas index misalignment. A common pitfall when performing arithmetic operations between Pandas series or data frames is index misalignment. Pandas attempts to align data based on their indices before performing the operation. If an index label exists in one series/data frame, but not the other, Pandas will insert code snippet, not a number, for that position in the result. Consider what happens if we directly divide code snippet by code snippet. Download the code on OnePageCode Substack. As you can see, the result is full of code snippet values. This is because code snippet has indices code snippet, while code snippet has indices code snippet. When Pandas tries to divide the row with index code snippet from code snippet by the row with index code snippet from code snippet, it works. However, for an index like code snippet in code snippet, there's no corresponding code snippet in code snippet, so the result for that row becomes code snippet. Conversely, for index code snippet in code snippet, there's no code snippet in code snippet, leading to code snippet there too. This behavior is by design for robust data merging, but requires awareness when performing time series calculations. Solution 1. Using the code snippet attribute. To bypass Pandas index alignment and treat the data frames as raw NumPy arrays, you can extract their underlying NumPy array using the code snippet attribute. This is useful when you explicitly want element-wise operations without index matching. Download the code on OnePageCode Substack. This correctly calculates T. He returns by operating directly on the underlying numerical arrays. However, the result is a NumPy array, not a Pandas series or data frame, which might not be ideal if you want to retain Panda's index and column labels. Solution 2. Using the code snippet method. The code snippet method is a powerful Pandas function specifically designed for time series manipulation. It shifts the data by a specified number of periods. A positive code snippet value shifts data down, forward in time, effectively lagging the data, while a negative value shifts it up, backward in time, leading the data. To calculate returns, we need the price from the previous period. Therefore, we shift the original price column by code snippet. Download the code on OnePageCode Substack. Notice that the first value of code snippet is code snippet. This is because there is no previous price for the very first price point in our series. This code snippet is intentional and correct, as a return cannot be calculated for the first period. Now, we can perform the division using the original price column and the code snippet series. Pandas will automatically align these two series by their indices, making the operation robust. Download the code on OnePageCode Substack. This method is clean, robust, and maintains the Pandas series structure, which is generally preferred for financial data analysis. The most efficient method, Pandas code snippet. For calculating single-period percentage changes, Pandas Provi. The dedicated and highly optimized method, code snippet. This method is the idiomatic and most efficient way to compute returns directly on a series or data frame. It handles the shifting and division internally, returning a new series or data frame with the percentage changes. Download the code on OnePageCode Substack. As with the code snippet method, the first value is code snippet because there is no preceding data point to calculate a return from. This is expected and correct behavior. Handling code snippet values. Code snippet values are common in financial data, especially at the beginning of return series. While they correctly indicate the absence of a calculable return, you often need to handle them before further analysis. One common approach is to drop rows containing code snippet values, especially if the code snippet only appears at the beginning of the series. Download the code on OnePageCode Substack. Alternatively, for scenarios where code snippet might appear elsewhere due to missing data, not just at the start, you might choose to fill them with a specific value, such as 0 or the previous valid observation, depending on your analytical needs. For returns, dropping the initial code snippet is often the most appropriate. Calculating returns for multiple assets. The code snippet method truly shines when dealing with multiple assets within a single data frame. It can be applied directly to the entire data frame, calculating returns for each column independent. TLY. Let's create a dummy data frame with prices for Tech Corp Incorporated, TCI, and Global Bank Corporation, GBC. Download the code on OnePageCode Substack. Now, applying code snippet to the entire data frame will compute returns for both assets simultaneously. Download the code on OnePageCode Substack. This demonstrates the power and conciseness of code snippet for portfolio-level analysis, providing a clean data frame of returns ready for further processing. Performance benefits of vectorized operations. While our examples use small data sets, the performance benefits of vectorized operations, NumPy and Pandas, over explicit Python loops become dramatically apparent with larger datasets, which are common in real-world financial analysis. For a dataset with thousands or millions of price points, a Python loop would be orders of magnitude slower than the equivalent NumPy or Pandas operation. This efficiency is critical for quantitative trading and large-scale data processing. Building blocks for further analysis. The single-period returns calculated in this section are crucial. They serve as the foundation for almost every subsequent financial metric. For example, volatility. The standard deviation of single-period returns is a common measure of an asset's price fluctuations. Cumulative returns. Compounding single-period returns allows you to calculate the total return over longer periods. Risk-adjusted performance. Metrics like the Sharpe ratio rely on both returns and volatility. Backtesting trading strategies. Returns are the primary input for evaluating the profitability of quantitative trading strategies. By mastering the practical calculation of single-period returns, you establish a solid foundation for more advanced quantitative financial analysis. Calculating two-period terminal return. The concept of return compounding is fundamental in finance, allowing us to accurately measure the growth of an investment over multiple periods. While single-period returns provide a snapshot of performance for a given interval, a two-period terminal return specifically calculates the total compounded return from the initial point of the first period to the end of the second period. This is distinct from simply adding the two single-period returns, as it correctly accounts for the effect of returns earning returns. Mathematically, if we have a return dollar, our $1 for the first period and dollar, our $2 for the second period, the two-period terminal return is calculated as $, 1 plus our 1, 1 plus our 2, $1. This formula highlights the importance of the code snippet format, which represents the growth factor of an investment. Multiplying these growth factors across periods directly reflects the compounding effect. Subtracting code snippet at the end converts the cumulative growth factor back into a percentage return. Setting up our data from prices to single-period returns. To calculate a two-period terminal return programmatically, we first need to start with price data and derive the single-period returns. We'll use the code snippet library, which is ideal for handling financial time series. First, let's import the necessary libraries and create a sample code snippet representing asset prices over 3 periods. Download the code on one patch code substa. CK. This code snippet data frame represents the value of an asset at different points in time. To calculate the returns for each period, we use the code snippet method. Download the code on one patch code substack. When you run code snippet, you'll notice that the first entry in code snippet is code snippet, not a number. This is because there's no preceding price to calculate the return for the first period. This code snippet is expected and will be handled gracefully by our subsequent compounding operations. The first actual return code snippet represents the return from January 1st, 2023 to January 2nd, 2023, and code snippet again for January 2nd, 2023 to January 3rd, 2023. The 1 plus R format, the key to compounding. As discussed, compounding requires us to work with growth factors, not just raw percentage returns. The code snippet format directly converts a percentage return code snippet into its corresponding growth factor. For example, a 5% return, $0.05, becomes $1.05. We can apply this transformation element-wise to our code snippet using a simple addition operation in Pandas. Download the code on one patch code substack. Notice how the code snippet value from code snippet is preserved in code snippet. This is important because it represents the absence of a return for that period, and any multiplication involving code snippet would typically result in code snippet. However, aggregation functions like code snippet are designed to handle this. Calculating the product. Compounding with the snippet. Once our returns are in the code snippet format, calculating the compounded return for multiple periods simply involves multiplying these code snippet values together. The code snippet function is excellent for this, as it calculates the product of all elements in an array or series. Download the code on one patch code substack. Crucial detail, code snippet handling by code snippet. It's vital to understand that code snippet and Pandas code snippet ignore code snippet values by default when computing the product. This behavior is incredibly convenient and correct for return calculations. If code snippet did not ignore code snippets, the presence of the initial code snippet from code snippet would result in the entire product becoming code snippet, making the calculation impossible without explicit code snippet removal. By skipping code snippets, code snippet effectively calculates the product of the valid growth factors. Finally, to get the two-period terminal return as a percentage, we subtract code snippet from the cumulative growth factor. Download the code on one patch code substack. This value represents the total percentage return from the beginning of the first period, implied by the first valid return, to the end of the second period. Pandas code snippet method, a more idiomatic approach. Pandas data frames and series also have their own code snippet method, which often provides a more concise and Pandas idiomatic way to perform such calculations. behaves similarly to code snippet by default, including the handling of code snippet values. Download the code on one patch code Substack. As you can see, the result is identical to using code snippet. The method chaining code snippet makes the code very readable. And just like with number py, we subtract code snippet to get the final percentage return. Download the code on one patch code Substack. Both methods yield the same correct result, demonstrating the flexibility of Python's scientific computing libraries. Illustrative example, tracking dollar value. To solidify the understanding of compounding, let's trace the actual dollar value of an investment over these two periods. This helps connect the abstract percentage returns to concrete financial outcomes. Suppose you start with an initial investment of code snippet. Download the code on one patch code Substack. Now, let's calculate the value after each period. Download the code on one patch code Substack. The final value, code snippet, perfectly matches the last price in our code snippet data frame, which makes sense as the returns were derived from those prices. Now, let's verify that our calculated two-period terminal return correctly translates this initial investment into the final value. Download the code on one patch code Substack. This confirms that the two-period terminal return accurately reflects the total growth of the investment over the two periods. It's a single percentage that, when applied to the initial investment, yields the final investment value. This type of calculation is crucial for accurately assessing the performance of short-term investments, such as a 2-month or 2-quarter performance review, generalizing to any 2 consecutive periods. While our example focused on the first 2 periods of a series, financial analysis often requires calculating 2-period returns for any consecutive periods within a larger time series. Panda's code snippet method combined with code snippet provides a powerful way to do this. Let's expand our price data to include more periods. Download the code on one patch code Substack. Now, we can use code snippet to select a 2-period window, and then code snippet to calculate the product of the code snippet values within each window. Download the code on one patch code Substack. Let's break down the output. The first 2 entries are code snippet because code snippet means it needs at least 2 valid values in the window to perform the calculation. The very first code snippet from code snippet means the first actual 2-period return can only be computed starting from the 3rd period. The return for code snippet, 0.1025, is the compounded return from code snippet to code snippet, which is code snippet. The return for code snippet, minus 0.0204, is the compounded return from code snippet to code snippet, which is code snippet. Note that the return for January 4th, 2023 is code snippet. This code snippet approach is highly flexible and can be adapted to calculate compounded returns over any code snippet periods by changing the code snippet parameter. Common pitfalls and best practices. When calculating 2-period terminal returns, keep the following in mind. Forgetting the code snippet transformation. A common error is to try to multiply raw percentage returns directly, e.g., code snippet. This is incorrect for compounding. Always convert to the code snippet format first. Forgetting to subtract code snippet. After multiplying the code snippet factors, the result is a cumulative growth factor, e.g., code snippet. To express this as a percentage return, you must subtract code snippet, e.g., code snippet or code snippet. Misunderstanding code snippet handling. While code snippet functions generally handle code snippets correctly by ignoring them, it's crucial to be aware of this behavior. If you were using a function that didn't ignore code snippets, you would need to explicitly drop them, e.g., code snippet, before calculating the product. Distinguishing simple versus compounded returns. For multi-period analysis, always use compounded returns unless a specific context, like average return for specific statistical purposes, explicitly calls for simple addition. Compounding accurately reflects the reality of investment growth. Data alignment. Ensure your price and return data are correctly aligned by date or time, especially when working with multiple assets or different data sources. Pandas handles this well through its indexing capabilities. Calculating annualized returns. The importance of annualized returns. Annualized return is a standardized financial metric that converts returns from different time frequencies, e.g., daily, monthly, quarterly, into an equivalent annual rate. This standardization is crucial for investment analysis because it allows for a fair and consistent comparison of investment performance, regardless of how frequently their returns are reported. Without annualization, directly comparing a stock's 0.1% daily return to a bond's 1.2% monthly return would be misleading and could lead to incorrect investment decisions. This concept builds directly on our understanding of compounding, which was introduced in the Calculating Two-Period Terminal Return section. Returns do not simply add up linearly over time. They compound, meaning that returns earned in one period also start earning returns in subsequent periods. Annualization explicitly incorporates this compounding effect to reflect the true, effective growth rate of an investment over a full year. The general annualization formula. The core principle of annualization is to determine what constant periodic return, compounded over a year, would yield the same total growth as the observed periodic return. The general formula for annualizing a periodic return is code snippet, where code snippet is the return observed over a specific period, e.g., daily, monthly, quarterly. This should be expressed as a decimal, e.g., 0.01 for 1%. Code snippet is the number of such periods in a year. Understanding the compounding effect in annualization. A common misconception is to simply multiply a periodic return by the number of periods in a year to get an annual return. For example, if an investment yields 1% per month, one might incorrectly assume an annual return of 1% 12 equals 12%. This approach, known as simple annualization, ignores the powerful effect of compounding. Let's illustrate the difference with an example. An initial investment of $100 earning 1% per month. Initial investment, $100. End of month 1, $100. 1 plus 0.01 equals $101. End of month 2, $101. 1 plus 0.01 equals $102.01. The 1% return is now applied to the $101, not just the initial $100. End of month 3, $102.01. 1 plus 0.01 equals $103.0301, and so on. If this process continues for 12 months, the total value after 1 year would be $100. 1 plus 0.01. Caret 12 equals $112.68. The total return over the year is calculated as code snippet, or 12.68%. This 12.68% is the true annualized return, which is higher than the simple 12% because the returns earned in earlier months also generate returns in subsequent months. This compounding phenomenon is precisely what the code snippet part of the formula captures. Subtracting code snippet then isolates the net return. This concept is also closely related to the effective annual rate, ER, which is frequently used in finance to express the true annual interest rate on a loan or investment when compounding occurs more frequent. Why than once a year? The annualized return calculation we perform is essentially deriving an effective annual rate from a periodic return, determining code snippet periods per year. The value of code snippet depends critically on the frequency of the code snippet you are annualizing. Daily returns, typically code snippet trading days. This standard accounts for weekends and common market holidays when major financial markets are closed. While there are 365 calendar days in a year, financial returns for assets like stocks are usually based on trading days, as these are the periods when price changes actively occur. In specific contexts or for non-trading assets, code snippet might be used. Weekly returns, code snippet weeks in a year. Monthly returns, code snippet months in a year. Quarterly returns, code snippet quarters in a year. Semi-annual returns, code snippet periods in a year. It is crucial to select the correct code snippet that accurately corresponds to the frequency of your code snippet to ensure a meaningful annualization. Basic annualization calculations in Python. Let's apply the annualization formula using Python. We will start by demonstrating direct, step-by-step calculations for various return frequencies. Daily return annualization. Suppose an investment yields a daily return of 0.01%, expressed as code snippet in decimal form. We will annualize this using the standard code snippet trading days per year. Download the code on OnePageCode Substack. Okay. In this code snippet is set to its decimal equivalent. Code snippet is 252, representing the number of trading periods in a year. The code snippet operator performs exponentiation, raising code snippet to the power of code snippet. Finally, we subtract 1 to get the net annualized return. The output is formatted to display the values as percentages, which is common practice in finance. Monthly return annualization. Next, let's consider an investment that yields a monthly return of 0.8%, or code snippet as a decimal. Download the code on OnePageCode Substack. Similar to the daily example, we apply the annualization formula using the monthly return and 12 periods per year. This demonstrates how even a relatively small monthly return can compound into a significantly higher annualized figure over a year. Quarterly return annualization. Finally, let's annualize a quarterly return of 2.5%, or code snippet as a decimal. Download the code on OnePageCode Substack. This example completes our basic demonstrations, showing the consistent and straightforward application of the annualization formula across different periodicities. Encapsulating annualization logic with a Python function. To promote code, reusability, maintainability, and clarity, it is considered best practice to encapsulate common calculations within functions. Let's create a Python function code snippet that takes the periodic return and the number of periods per year as its inputs. Download the code on OnePageCode Substack. This code snippet function includes a comprehensive docstring that explains its purpose, parameters, return value, and potential exceptions. This is crucial for creating well-documented and understandable code. We've also added basic input validation to handle cases where code snippet might be non-positive or where extreme negative returns combined with fractional code snippet could lead to non-real, complex numbers, though the latter is rare in practical financial annualization. Now, let's use our new code snippet function for the previous examples. This demonstrates how the function streamlines our calculations. Download the code on OnePageCode Substack. By using the code snippet function, our code becomes cleaner, more readable, and less prone to errors from repeatedly typing out the formula. This modular approach is fundamental in building robust financial analysis tools. Annualizing returns from a series of historical data. Often, you won't be given a single periodic return directly. Instead, you'll have a series of historical returns over a specific period, e.g., daily returns for a month, or monthly returns for several years. To annualize the performance over such a period, you first need to calculate the total compounded return for that entire period and then annualize that total return. Let's consider an example where we have a series of monthly returns for a 6-month period, and we want to annualize the overall performance observed during these 6 months. Download the code on OnePageCode Substack. We use a number-py array to store the series of monthly returns. Number-py is a foundational library for numerical operations in Python and is widely used in quantitative finance for its efficiency and powerful array manipulation capabilities. To calculate the total compounded return over these 6 months, we follow the principle of compounding. Code snippet. Download the code on OnePageCode Substack. The code snippet function efficiently calculates the product of all elements in the code snippet array. This results in the total growth factor over the period. Subtracting 1 then yields the net total compounded return for the entire 6-month duration. Now that we have the code snippet, which represents the return over a 6-month period, we can annualize it. The key is to determine the appropriate code snippet for our code snippet function. If this return is for 6 months and a year has 12 months, then this 6-month period represents code snippet such periods in a year. More generally, code snippet, in our case, The code snippet for annualization is code snippet, and code snippet is code snippet. Since 6 months is 0.5 years, code snippet. Download the code on one patch code Substack. This method is crucial when you have a total return that spans a period not equal to one of the standard intervals, e.g., a 7-month return. By first calculating the total compounded return for that specific duration, and then using code snippet as t. Code snippet in our annualization function, we correctly scale it to an annual equivalent. Practical application: comparing investments. Annualized returns are an invaluable tool for comparing investment options that report returns on different frequencies or over different time frames. Scenario: you are evaluating 2 investment options over the past year. 1. Stock A reports daily returns. Its average daily return over the year was 0.05%. 2. Mutual Fund B reports quarterly returns. Its average quarterly return over the year was 1.5%. Which investment performed better on an annualized basis? Download the code on one patch code Substack. By annualizing both returns, we can see that stock A, despite its seemingly small daily return, actually delivered a higher annualized performance due to the power of daily compounding. This example clearly illustrates why annualization is not just a theoretical concept, but a practical necessity for making informed investment comparisons and decisions. Limitations and assumptions of simple annualization. While essential for comparative analysis, simple annualization, as calculated using the formula above, comes with certain inherent assumptions and limitations that are important to understand. 1. Constant periodic return assumption. The formula assumes that the code snippet provided is either constant or perfectly representative of the average return that would persist over the entire year. In reality, investment returns fluctuate significantly over time, making this a strong simplification. 2. Reinvestment assumption. The calculation implicitly assumes that any returns generated within a period are immediately reinvested at the same periodic rate. If an investor withdraws profits, or if the returns cannot be reinvested at the same rate, the actual compounded return will be lower than the annualized figure. 3. Does not account for volatility/risk. Simple annualization provides only a single-point estimate of return. It conveys no information about the risk or volatility of the investment. 2 investments could have the exact same annualized return but vastly different risk profiles. For example, one might have very stable periodic returns, while the other might experience large, unpredictable swings, yet both could end up with the same annualized figure. 4. Historical versus forward-looking. When applied to historical data, the annualized return tells us what the past annual performance was. It is crucial to remember that past performance is not indicative of future results. 5. Applicability to extreme negative returns. While the formula mathematically works for negative periodic returns, interpreting annualized negative returns requires care. If the code snippet term becomes negative, e.g., a periodic loss of 100% or more, raising it to a power can yield complex numbers or nonsensical results, particularly if code snippet is not an integer. For typical financial returns, which rarely fall below minus 100% in SI, angle period, this is usually not an issue. Understanding these limitations is crucial for a complete and nuanced picture of investment performance and for avoiding misinterpretation of annualized figures. For more robust analysis, especially when dealing with highly volatile assets or non-constant returns, more advanced techniques like geometric mean annualization, which we touched upon when annualizing a series, or risk-adjusted return measures, e.g., Sharpe ratio, are employed, building upon the foundational understanding of compounding and annualization. Analyzing risk. While understanding how to calculate returns is fundamental, it only tells half the story of an investment. A high return is attractive, but it becomes less so if achieving it involves a high degree of uncertainty or the potential for significant losses. This uncertainty is what we define as financial risk. What is financial risk? In the context of financial assets and investments, Financial risk refers to the uncertainty surrounding the future returns of an investment, or more broadly, the probability that an investment's actual return will differ from its expected return. This deviation can be positive or negative, but in common parlance, risk is often associated with the potential for losing money or failing to meet investment objectives. It's crucial to distinguish risk from return. Return is the reward for an investment, representing the percentage gain or loss over a period. Risk, on the other hand, quantifies the variability or dispersion of those returns. An asset with highly predictable returns, even if they are modest, is generally considered less risky than an asset whose returns fluctuate wildly, even if its average return is high. This unpredictability means there's a higher chance that the actual outcome will be significantly different from what was anticipated. Volatility, a key measure of risk. When we talk about financial risk in quantitative terms, we most often refer to volatility. Volatility is a statistical measure of the dispersion of returns for a given security or market index. In simpler terms, it quantifies how much an asset's price or returns code snippet over a period. Consider two assets. Asset X has daily returns that consistently hover around 0.1% to 0.2%. Asset Y has daily returns that swing from -5% to +7% on different days. Even if both assets have the same average daily return over a long period, Asset Y is clearly more volatile. Its returns are more spread out from their average, indicating a higher degree of uncertainty and thus higher risk. Higher volatility implies that the asset's value can change dramatically over a short period, potentially leading to large gains or large losses. Conversely, low volatility suggests that an asset's value tends to remain relatively stable. The risk-return trade-off. A fundamental principle in finance is the risk-return trade-off. This concept posits that potential returns rise with an increase in risk. To put it another way, if an investor wants to achieve higher potential returns, they generally must be willing to accept higher levels of risk. Why does this trade-off exist? Investors are rational beings who typically prefer more return for less risk. Therefore, for an asset to attract investment despite carrying higher risk, it must offer the promise of proportionally higher returns to compensate investors for taking on that increased uncertainty. Low-risk investments, such as government bonds or savings accounts, typically offer lower returns because the probability of losing capital is minimal. High-risk investments like individual stocks, emerging market equities, or speculative assets offer the potential for significantly higher returns, but also carry a greater chance of substantial losses. It's important to understand that this is a general principle, not a guarantee. There's no assurance that taking on higher risk will always lead to higher returns. It merely implies the potential for them. The goal of effective investment management is to find the optimal balance of risk and return that aligns with an individual's financial goals and risk tolerance. Intuition behind quantifying volatility, variance, and standard deviation. While volatility is easy to understand conceptually, we need specific statistical measures to quantify it. The two most common measures for this purpose are variance and standard deviation. These measures are designed to capture the code snippet of a dataset around its mean average. Imagine plotting the daily returns of an asset. The average return would be a central line. Variance and standard deviation tell us how far, on average, the individual daily returns deviate from that central line. Variance measures the average of the squared differences from a mean. The squaring of the differences serves two main purposes. 1. It ensures that all differences, both positive and negative, contribute positively to the measured dispersion. 2. It penalizes larger deviations more heavily, meaning an asset with a few very large swings will have a higher variance than one with many small swings, even if the average deviation is similar. Standard deviation is simply the square root of the variance. The reason we take the square root is critical. It brings the unit of measurement back to the same scale as the original data. If our returns are expressed as percentages, the standard deviation will also be in percentages, making it much more intuitive and directly comparable to the returns themselves. A larger standard deviation indicates that the returns are more spread out from the average return, implying greater volatility and thus higher risk. Conversely, a smaller standard deviation indicates less variability and lower risk. This quantitative approach allows us to move beyond just visual assessment, such as observing asset twos, more significant ups and downs in a chart. These statistical measures provide a precise numerical value that quantifies exactly how much those ups and downs deviate from the average, making risk comparison objective. Connecting to practice, calculating volatility with code snippet. In previous sections, we've already encountered the code snippet function when exploring descriptive statistics for returns. This function, provided by the code snippet library, is precisely how we quantify standard deviation, which we now understand as our primary measure of volatility. Let's revisit this with a simple illustrative example. First, we'll set up some hypothetical return data for two different assets. Download the code on one patch code Substack. Here, we've created two code snippet objects, code snippet and code snippet. We've designed code snippet to have small, consistent fluctuations around zero, while code snippet exhibits larger, more erratic movements. This setup allows us to easily observe the impact of volatility on our calculated standard deviation. Next, we will calculate the standard deviation for asset A's returns using the code snippet method. Download the code on one patch code Substack. By calling the code snippet method directly on code snippet efficiently computes the standard deviation of these returns. The output, code snippet, is a single numerical value that quantifies the typical deviation of asset A's daily returns from its average return. A smaller value indicates less dispersion and thus lower volatility. Finally, let's calculate the standard deviation for asset B and compare it to asset A. Download the code on one patch code Substack. As anticipated, code snippet will be a larger number than code snippet. This quantitative difference confirms our visual intuition. Asset B, with its larger and more erratic return swings, is indeed more volatile than asset A. This simple demonstration highlights how standard deviation provides a clear, objective measure to compare the risk profiles of different financial assets, moving beyond qualitative descriptions to precise numerical analysis. Introducing variance and standard deviation. Financial risk, particularly for asset returns, is often quantified using statistical measures that describe the dispersion or spread of data points around their average. Two fundamental measures for this purpose are variance and standard deviation. They provide a precise way to express the volatility of an investment, which is a key component of its risk profile. Understanding variance as a measure of dispersion. Variance quantifies how far a set of numbers, in our case, asset returns, are spread out from their average value. A higher variance indicates that the individual data points tend to be further from the mean, implying greater dispersion and, consequently, higher volatility or risk. The calculation of variance involves several steps. 1. Calculate the mean. Determine the arithmetic average of all the returns in the dataset. This establishes the central point around which we measure dispersion. 2. Calculate deviations from a mean. For each individual return, subtract the mean. This tells us how much each return deviates from the average. Some deviations will be positive, return was above average, and some will be negative, return was below average. 3. Square the deviations. Each deviation is then squared. This step is crucial for two reasons. Preventing cancellation. If we simply sum the deviations, positive and negative deviations would cancel each other out, leading to a sum of zero. Squaring ensures all values are positive, so they contribute to the total measure of dispersion regardless of whether the original deviation was positive or negative. Emphasizing larger deviations. Squaring gives disproportionately more weight to larger deviations. A deviation of 2, when squared, becomes 4, while a deviation of 1 becomes 1. This means that returns significantly far from the mean contribute more to the overall variance, reflecting that extreme outcomes are a greater source of risk. 4. Sum the squared deviations. Add up all the squared deviations. This gives us the total sum of squares, or sum of squared errors. 5. Average the sum of squared deviations. Divide the sum of square deviations by the number of data points. This gives us the average square deviation, which is the variance. The unit of variance is the square of the unit of the original data. For example, if returns are expressed as percentages, variance will be in percentage squared. This squared unit can make variance less intuitive to interpret directly in a financial context compared to standard deviation. Introducing standard deviation, the interpretable risk measure. Standard deviation is simply the square root of the variance. By taking the square root, we bring the measure of dispersion back to the original units of the data. If returns are in percentages, standard deviation will also be in percentages. This makes standard deviation much more interpretable and directly comparable to the returns themselves. 4. Example, if an asset has an average monthly return of 1% and a standard deviation of 3%, it implies that typical monthly returns are expected to vary by about 3% around the 1% average. This provides a more intuitive sense of the spread of returns. In finance, standard deviation is the most commonly used quantitative measure of volatility. A higher standard deviation indicates higher volatility and thus higher risk, as it suggests that the asset's returns are likely to fluctuate more widely around their average. Conversely, a lower standard deviation indicates lower volatility and lower risk. Population versus sample variance and standard deviation. When calculating variance and standard deviation, it's important to distinguish between whether you are analyzing an entire dataset, a population, or a subset of that data, a sample. The formulas differ slightly, specifically in the denominator used for averaging. Population variance, $sigma, $2, and standard deviation, $sigma. If your dataset represents the entire population of returns, e.g., all possible returns for a theoretical asset over its entire existence, or every single return observed for an asset, if you have truly exhaustive data, you use the following formulas. $sigma стрижка 2 ровно фрац лявазложена затворка сум лявазложена затворка и ровно 1 правазложена затворка стрижка лявазложена затворка n правазложена затворка 11 му стрижка 2 правазложена затворка лявазложена затворка n правазложена затворка $. Sigma rovno SQRT лявазложена затворка, фрац лявазложена затворка, сум лявазложена затворка и ровно 1 правазложена затворка, стрижка лявазложена затворка, n правазложена затворка, 11 му стрижка 2 правазложена затворка, лявазложена затворка, n правазложена затворка, правазложена затворка, $. Where $11 is each individual return. $mu is the population mean, average of the returns. $and is the total number of returns. In the population, $sum sigma denotes summation. Sample variance, $2, and standard deviation, $s. In most practical financial applications, we only have access to a sample of past returns, e.g., historical daily returns for the last 5 years. We use this sample to estimate the true population variance and standard deviation. When working with a sample, the denominator for variance changes from $and to $n, $1. This adjustment is known as Bessel's correction. $s squared equals \frac sum I equals 1 11 bar x 2 $1. $s equals \sqrt \frac sum I equals 1 11 bar x 2 $. Where $11 is each individual return in the sample. $bar x bar is the sample mean average of the returns. $and is the number of returns in the sample. $y in $1. The concept of degrees of freedom. The use of $n, $1 in the denominator for sample variance and standard deviation is crucial for obtaining an unbiased estimate of the true population variance. Here's an intuitive explanation of why. When you calculate the sample mean, $\bar gex dollar, you're using the sample data itself. This sample mean is, by definition, the center of that specific sample. The individual data points in the sample will, on average, be closer to their sample mean than they would be to the true population mean, which is unknown. If we were to divide by dollar and dollar for a sample, our calculated sample variance would consistently underestimate the true population variance. This is because the deviations from the sample mean are, on average, smaller than the deviations from the unknown true population mean. The term code snippet refers to the number of independent pieces of information available to estimate a parameter. When calculating the sample mean, we use up 1 degree of freedom. If you have dollar and dollar data points and you've already calculated their mean, then $1 of those data points can vary freely, but the $($) data point is fixed once the mean and the other $1 values are known. For example, if you have two numbers and their mean is 5, if the first number is 3, the second must be 7. It's not free to vary. Dividing by $1 effectively corrects for this underestimation, providing a more accurate and unbiased estimate of the population variance based on the sample data. In financial analysis, where we almost always work with samples of historical data to infer future behavior, using the sample variance formula with $1 is the standard practice. Limitations of standard deviation as a sole risk measure. While standard deviation is a powerful and widely used measure of volatility, it's important to recognize its limitations. Symmetry assumption. Standard deviation treats both upside, positive, and downside, negative deviations from the mean equally. In finance, investors are often more concerned about downside risk, losing money, than upside volatility, making more money than expected. Other risk measures, like semi-variance or value at risk, VAR, specifically focus on one-side deviations. Normal distribution assumption. Standard deviation is most informative when returns are normally distributed. However, financial returns often exhibit fat tails, more extreme positive and negative events than a normal distribution would predict, and skewness, asymmetric distributions, meaning standard deviation alone might not fully capture the true risk of extreme events. Historical nature. Standard deviation is calculated using historical data. While past volatility can be a good indicator, it doesn't guarantee future volatility will be the same. Market conditions can change rapidly. Despite these limitations, standard deviation remains a cornerstone of financial risk analysis due to its simplicity, interpretability, and its role as a building block for more advanced quantitative models. Step-by-step manual calculation example. To solidify your understanding, let's walk through a manual calculation of variance and standard deviation for a very small dataset of hypothetical monthly returns. Suppose we have the following 3 monthly returns for an asset. Code snippet, i.e., 2%, -1%, 3%. First, let's set up our data in Python. Download the code on one pagecode Substack. This initializes a number py array with our sample returns. Step 1. Calculate the mean, $\bar vex dollar. The mean is the sum of returns divided by the number of returns. Download the code on one pagecode Substack. The average monthly return for this asset is 1.33%. Step 2. Calculate deviations from a mean, $11 x dollar. Subtract the mean from each individual return. Download the code on one pagecode Substack. As expected, some deviations are positive and some are negative. Step 3. Square the deviations $11 x $2. Square each of the deviations. Download the code on one pagecode Substack. Notice all values are now positive, and larger deviations, like the -0.0233, become proportionally larger after squaring. Step 4. Sum the squared deviations $sum 11 bar x $2. Add up all the squared deviations. Download the code on one pagecode Substack. This sum represents the total dispersion before averaging. Step 5. calculate sample variance, $s$2. Divide the sum of square deviations by $n, $1. Here, $n equals $3, so $n, 1 equals $2. Download the code on OnePageCode Substack. The sample variance for this set of returns is approximately 0.000733. Step 6. Calculate sample standard deviation, $s$. Take the square root of the sample variance. Download the code on OnePageCode Substack. The sample standard deviation is approximately 0.0271, or 2.71%. This value is in the same units as our original returns, making it much easier to interpret. Calculating variance and standard deviation with NumPy. While manual calculation is excellent for understanding the underlying mechanics, in practice, you'll use powerful libraries like NumPy and Pandas for efficiency and accuracy. NumPy's code snippet and code snippet functions provide direct ways to compute these statistics. Crucially, they include a code snippet, delta degrees of freedom, parameter to specify whether to calculate population or sample statistics. Code snippet default divides by code snippet for population variance / standard deviation. Code snippet divides by code snippet for sample variance / standard deviation, Bessel's correction. Let's apply this to our small code snippet array. Download the code on OnePageCode Substack. Here, we explicitly set code snippet to get the population statistics, dividing by code snippet. Download the code on OnePageCode Substack. By setting code snippet, NumPy correctly applies Bessel's correction, providing an unbiased estimate for the population variance / standard deviation based on our sample. Notice these match our manual calculations. Calculating variance and standard deviation with Pandas. Pandas, built on top of NumPy, offers even more convenient methods for financial data, particularly when working with code snippet for single assets or code snippet for multiple assets. Pandas code snippet and code snippet methods also use the code snippet parameter, with code snippet being their default behavior, which is appropriate for financial time series data, as we usually have a sample. Let's use our code snippet data, but convert it to a Pandas series first. Download the code on OnePageCode Substack. Pandas default for code snippet and code snippet is code snippet, which is often what you need for financial samples. UCA. And explicitly set code snippet if you intend to treat your series as a full population. Download the code on OnePageCode Substack. Applying to multiple assets. Comparing volatility. Let's apply these concepts to hypothetical code snippet and code snippet data, which might have been previously introduced visually, e.g., in Figure 4.3, showing code snippet as more volatile. We can now quantitatively confirm this observation. Download the code on OnePageCode Substack. The output clearly shows that code snippet has a significantly higher standard deviation, 0.0409 or 4.09%, compared to code snippet, 0.0044 or 0.44%. This numerical result directly quantifies the visual observation that code snippet exhibits much greater volatility and, therefore, higher risk. When analyzing multiple assets, it's often convenient to put them into a Pandas data frame. The code snippet and code snippet methods can then be applied directly to the data frame. By default, they operate column-wise, which is ideal for financial data where each column represents an asset. Download the code on OnePageCode Substack. This output confirms the individual asset calculations and demonstrates how easily you can compare the risk profiles of multiple investments using Pandas. The higher standard deviation and variance for code snippet immediately signal its higher volatility. In summary, variance and standard deviation are indispensable tools for quantifying financial risk. By understanding their calculation and proper application, especially the code snippet adjustment for samples, you gain a robust way to measure and compare the volatility of different investment opportunities. Annualizing volatility. Financial assets generate returns over various time periods, daily, weekly, monthly, or quarterly. To effectively compare the risk profiles of different investments, especially those with return data collected at different frequencies, we need a standardized measure. Annualized volatility serves precisely this purpose, converting volatility from any given period into an equivalent annual measure. This allows for an apples-to-apples comparison of risk. The core principle: scaling volatility. Volatility, measured as the standard deviation of returns, does not scale linearly with time. Instead, it scales with the square root of time. This is a crucial distinction from returns, which are typically annualized by simple multiplication, e.g., multiplying daily returns by 252 for annual returns. The fundamental formula for annualizing volatility is $sigma annual equals sigma period times $, where $sigma annual is the annualized volatility. $sigma period is the volatility, standard deviation, over the single period, e.g., daily, monthly, quarterly. $T is the number of periods in a year. Common values for $T based on the frequency of the code snippet volatility. Daily volatility. $T equals $252, approximate number of trading days in a year. Weekly volatility. $T equals $52, number of weeks in a year. Monthly volatility. $T equals $12, number of months in a year. Quarterly volatility. $T equals $4, number of quarters in a year. Why the square root? An intuitive explanation. The square root scaling of volatility is rooted in the assumptions underlying financial models, particularly the concept of a random walk for asset prices. If we assume that asset returns are independent and identically distributed, i.d., over discrete time intervals, then the variance of returns over a longer period is simply the sum of the variances of the returns over the shorter, non-overlapping periods. Consider a simple random walk. If you take one step, your displacement has a certain standard deviation. If you take two independent steps, your total displacement's variance is the sum of the individual variances. Since standard deviation is the square root of variance, the standard deviation of the total displacement grows with the square root of the number of steps. In finance, this means that if daily returns are independent, the total spread, or uncertainty volatility, of returns over a year is not simply 252 times the daily volatility. Instead, because random movements can partially offset each other, the cumulative uncertainty grows at a slower rate, proportional to the square root of the number of periods. This reflects the idea that while returns compound linearly, risk, as measured by standard deviation, accumulates more slowly due to the stochastic nature of market movements. Annualizing volatility versus variance, a key distinction. Understanding the difference in scaling between volatility and variance is crucial. Variance scales linearly with time. If daily returns have a variance of $var daily $, then the annualized variance is $var annual equals var daily times T $. Volatility scales with the square root of time. Since volatility $sigma is the square root of variance, it follows that $sigma annual equals annual equals security for daily times T equals daily times equals sigma daily times sqrtt $. This means that while variance is an additive measure over time, assuming independent returns, volatility is not. When making investment decisions or comparing risk, it's generally volatility that is presented and compared, precisely because its square root scaling reflects the nonlinear accumulation of risk over time more accurately from measures of dispersion. Underlying assumptions and their limitations. The volatility annualization formula relies on two primary assumptions. 1. Returns are normally distributed. The theoretical elegance of the standard deviation as a measure of risk and its scaling properties often assumes that returns follow a normal, Gaussian, distribution. Implications of deviation. Real-world financial returns, especially daily or intraday returns, rarely exhibit perfect normal distribution. They often display fat tails, more extreme positive and negative events than a normal distribution would predict, and sometimes skewness. If returns are not normally distributed, the annualization formula may still provide a reasonable approximation, but its theoretical validity and the interpretability of the annualized volatility in terms of standard deviations from the mean might be compromised. For instance, if returns have significantly fatter tails, the true annual risk might be underestimated. 2. Returns are independent and identically distributed. This means that the return in one period does not influence the return in the next period, and all periods have the same statistical properties: mean, variance. Real-world challenges. This assumption is often violated in financial markets. Autocorrelation. Returns can exhibit some degree of autocorrelation, meaning past returns can slightly predict future returns, especially over very short horizons. Volatility clustering. A more significant challenge is volatility clustering, where periods of high volatility tend to be followed by periods of high volatility and vice versa. This phenomenon, often modeled by GRCH, generalized autoregressive conditional heteroscedasticity, models, implies that volatility itself is not constant but changes over time. Implications for annualization accuracy. When returns are not independent, or when volatility is not constant, the simple square root of time rule can underestimate or overestimate the true long-term volatility. For example, if volatility clustering is strong, the annualized volatility calculated using a simple historical standard deviation might be lower than the true expected annual volatility, as it does in ACC. Out for periods of heightened risk persistence. For more precise risk management in such scenarios, more advanced models are often employed. Practical application and code examples. Let's demonstrate how to annualize volatility using Python. We'll use the code snippet library for numerical operations and code snippet for handling time series data. First, let's import the necessary libraries. Download the code on OnePageCode Substack. This code imports code snippet for mathematical operations like code snippet, square root, and code snippet for data structures like code snippet and code snippet, which are ideal for financial data. 5.1. Basic annualization of single-period volatility. We'll start with direct application of the formula for given single-period volatilities. Download the code on OnePageCode Substack. Here, we take a hypothetical daily volatility of 1.5% and multiply it by the square root of 252, the approximate number of trading days in a year, to get the annualized figure. This is a common conversion for short-term trading strategies. Download the code on OnePageCode Substack. Similarly, for a monthly volatility of 5%, we multiply by the square root of 12 months in a year. This is often used for longer-term investment analysis. Download the code on OnePageCode Substack. And for quarterly volatility, we use the square root of 4. This demonstrates the consistent application of the formula across different frequencies. 5.2. Annualizing volatility from SAM. PLE return data. In a real-world scenario, you would first calculate the single-period volatility from a series of returns. Download the code on OnePageCode Substack. We generate a code snippet of 2 years' worth of dummy daily returns. Code snippet creates data resembling a normal distribution, with a small positive mean, 0.0005, and a standard deviation, 0.01 or 1%. Download the code on OnePageCode Substack. Here, code snippet calculates the standard deviation of the daily returns. This is our code snippet. We then apply the code snippet factor to annualize it. Now, let's do the same for monthly data. Download the code on OnePageCode Substack. We generate dummy monthly returns, again with a small positive mean, 0.005, and a standard deviation, 0.03 or 3%. Download the code on OnePageCode Substack. This demonstrates the process for monthly data. Calculate monthly standard deviation, then multiply by code snippet. 5.3. Comparative analysis, making different frequencies comparable. Imagine we are evaluating two hypothetical assets, asset X and asset Y. Asset X has daily return data, and Asset Y has monthly return data. To compare their risk profiles, we must annualize their volatilities. Download the code on OnePatchCode Substack. This example clearly shows how annualization allows for a direct comparison. Even though Asset Y's monthly volatility for percent is much higher than Asset X's daily volatility, 1.2%, after annualization, Asset X might turn out to be riskier, depending on the exact values. In this specific example, Asset X's annualized volatility is approximately 0.1905, while Asset Y's is approximately 0.1386. Thus, Asset X, despite having a lower single-period volatility, is riskier on an annualized basis because its volatility is sampled much more frequently and compounded over more periods. 5.4. Why daily data can lead to higher annualized volatility. Intuition revisited. It might seem counterintuitive that a small daily volatility, when annualized, can result in a higher annual figure than a larger monthly volatility. The key lies in the code snippet factor. When you annualize daily volatility, you multiply by code snippet. When you annualize monthly volatility, you multiply by code snippet. The much larger annualization factor for daily data means that even a small daily standard deviation is amplified significantly over the course of a year. This reflects the fact that daily data captures more frequent, smaller fluctuations. Over 252 trading days, there are many more opportunities for the asset price to deviate from its mean path compared to just 12 monthly periods. Each of these daily deviations contributes to the overall annual uncertainty. While individual daily movements might be small, their cumulative effect over many independent periods, when measured by standard deviation, grows with the square root of the number of periods, leading to a substantial annualized risk. Summary of key takeaways. Annualizing volatility. ITY is an indispensable tool in quantitative finance for standardizing risk measures across different time horizons. It allows for meaningful comparisons of asset risk, portfolio performance, and strategy evaluations. The core principle involves scaling single-period volatility by the square root of the number of periods in a year. While powerful, it's vital to remember the underlying assumptions of normally distributed and independent returns, as real-world market phenomena like volatility clustering can affect the accuracy of this simple annualization, potentially necessitating more sophisticated risk modeling techniques. Combining risk and return via the Sharpe ratio. Evaluating investment performance goes beyond simply looking at returns. A high return achieved with extreme risk may not be as desirable as a moderate return achieved with low risk. To make informed decisions, we need a metric that combines both aspects, return and risk. This is where the Sharpe ratio comes in. The concept of risk-adjusted return. Before diving into the Sharpe ratio, let's consider a fundamental problem in investment analysis. Imagine two portfolios. Portfolio A returns 15% annually with 20% volatility. Portfolio B returns 10% annually with 5% volatility. Which portfolio is better? Portfolio A offers higher returns, but the cost of significantly higher volatility. Portfolio B offers lower returns, but is much more stable. A simple comparison of returns doesn't tell the whole story. We need a way to quantify how much return we are getting per unit of risk taken. This is the essence of risk-adjusted return. Introducing the Sharpe ratio. The Sharpe ratio, developed by Nobel laureate William F. Sharpe, is one of the most widely used metrics for calculating risk-adjusted return. It measures the excess return of an investment or portfolio relative to its total risk volatility. A higher Sharpe ratio indicates better risk-adjusted performance. The formula for the Sharpe ratio is $text Sharpe ratio equals \frac RP RF \sigmap where $RP equals return of the portfolio, $RF equals risk-free rate, $sigmap equals standard deviation of the portfolio's returns, i.e., its volatility. Let's break down each component. Portfolio return, $RP$. This is the total return generated by the investment or portfolio over a specific period. It could be daily, weekly, monthly, or annual return. Risk-free rate, $RF$. This represents the theoretical return an investor could earn without taking on any investment risk. It's the return you could get by simply putting your money into the safest possible asset. Common proxies include the yield on short-term government securities, such as U.S. Treasury bills, e.g., 3-month T-bills. The concept of a risk-free rate is crucial because it helps us understand the excess return, the return we get above what we could have earned without taking any risk. Portfolio volatility, $\sigmap$. This is the standard deviation of the portfolio's returns, serving as the primary measure of its total risk. A higher standard deviation indicates greater price fluctuations and thus higher risk. The numerator, $RP$, is known as the excess return. It signifies the additional return an investor receives for taking on the risk associated with the portfolio beyond what they could have earned from a risk-free asset. The denominator, $\sigmap$, quantifies the amount of risk taken to achieve that excess return. Therefore, the Sharpe ratio essentially tells us how much excess return did I get for each unit of risk I took. Step-by-step calculation of the Sharpe rat. Let's walk through a simple calculation with hypothetical data to solidify understanding. Imagine we have two hypothetical portfolios, Portfolio X and Portfolio Y, and a given risk-free rate. Download the code on OnePageCode Substack. Here, we initialize the annual return and volatility for two hypothetical portfolios, code snippet and code snippet. We also set a code snippet representing the return available from a risk-free investment. These values are expressed as decimals, e.g., 12% is 0.12. First, let's calculate a simple return-to-volatility ratio without considering the risk-free rate for initial comparison. This is often called the reward-to-variability ratio or return-to-risk ratio. Download the code on OnePageCode Substack. In this step, we calculate a basic return-to-volatility ratio for both portfolios. This metric simply divides the portfolio's total return by its total volatility. Based on this, Portfolio Y 0.83 appears to offer a better return per unit of risk than Portfolio X 1.20. However, this simple ratio ignores the opportunity cost of investing in a risky asset when a risk-free alternative exists. Now, let's incorporate the risk-free rate to calculate the excess return for each portfolio. This is the core difference that makes the Sharpe ratio a superior metric. Download the code on OnePageCode Substack. Here, we subtract the code snippet from each portfolio's return to determine its excess return. This value represents how much EXT RA return the portfolio generated above what could have been earned from a completely risk-free investment. This is a crucial step in evaluating performance beyond just absolute returns. Finally, we can compute the Sharpe ratio for both portfolios using the excess return and their respective volatilities. Download the code on OnePageCode Substack. By dividing the excess return by the volatility, we arrive at the Sharpe ratio. For Portfolio X, the Sharpe ratio is 0.90, and for Portfolio Y, it is 0.67. Interpretation. Based on the simple return-to-volatility ratio, Portfolio Y seemed better. However, after accounting for the risk-free rate, Portfolio X has a higher Sharpe ratio, 0.90 versus 0.67. This means Portfolio X offers more return per unit of risk taken above the risk-free rate. This highlights the power of the Sharpe ratio in providing a more nuanced and accurate comparison of risk-adjusted performance. Annualization and consistency in Sharpe ratio calculation. A critical aspect of calculating the Sharpe ratio is ensuring consistency in the time period of its components. The portfolio return $RP$, risk-free rate $RF$, and portfolio volatility $\sigmap$, must all correspond to the same time horizon, typically annualized. If you're using daily returns and daily volatility, You must also use a daily risk-free rate and then annualize the final Sharpe ratio. More commonly, all components are first annualized before the Sharpe ratio is calculated. Annualizing R2, RNS. If you have daily returns, you can annualize them by multiplying by the number of trading days in a year, e.g., 252 for equities. For monthly returns, multiply by 12. Annualizing volatility. Daily standard deviation is annualized by multiplying by the square root of the number of trading days in a year, $/SQRT, $252. Monthly standard deviation is multiplied by $/QRT, $12. Annualizing risk-free rate. If your risk-free rate is given on an annual basis, as is common for T-bills, and you're working with daily returns and volatility, you would need to convert the annual risk-free rate to a daily rate. Let's demonstrate how to annualize daily metrics. We'll assume we've calculated daily returns and daily volatility for a portfolio. Download the code on OnePageCode Substack. Here, we take hypothetical code snippet and convert them to their annualized equivalents. Returns are scaled linearly by the number of trading days, while volatility, standard deviation, is scaled by the square root of the number of trading days. This is a crucial step to ensure all inputs to the Sharpe ratio are on a consistent annual basis. Now, we can calculate the Sharpe ratio using these annualized figures. Note that the code snippet is already in annual terms, so no conversion is needed for it if we're using annualized portfolio metrics. Download the code on OnePageCode Substack. After annualizing all components, we compute the Sharpe ratio. This code snippet provides a standardized basis for comparing the risk-adjusted performance of different investments, regardless of the frequency of the underlying data. Implementing the Sharpe ratio as a Python function. For practical application, it's best to encapsulate the Sharpe ratio calculation within a reusable Python function. This promotes code cleanliness, reusability, and reduces errors. Download the code on OnePageCode Substack. This function, code snippet, takes the three necessary components as arguments: code snippet, and code snippet. It computes the excess return and then divides by volatility. A check for zero volatility is included to prevent code snippet. This function allows for easy and consistent calculation across various portfolios or time periods. Let's test this function with our previous hypothetical data. Download the code on OnePageCode Substack. By calling the code snippet function with our previously defined hypothetical values, we get the same results as our manual step-by-step calculation. This confirms the function works correctly and demonstrates its utility for streamlining calculations. Real-world application. Sharpe ratio with historical stock data. To truly understand the Sharpe ratio's power, let's apply it to actual historical stock data. We'll use the code snippet library to download stock prices and then calculate returns, volatility, and finally the Sharpe ratio. First, ensure you have code snippet and code snippet installed. Code snippet. Unload the code on OnePageCode Substack. We begin by importing necessary libraries and defining a list of stock tickers and a date range. The code snippet function fetches the historical code snippet prices for these tickers from Yahoo Finance. This adjusted closing price is crucial as it reflects the true value of the stock, accounting for corporate actions like dividends and stock splits. Next, we'll calculate the daily returns for each asset. Download the code on OnePageCode Substack. Here, we use the code snippet method on our price data frame to calculate daily percentage returns. Code snippet is then called to remove the first row, which will contain code snippet values as there's no preceding price to calculate a change from. This code snippet data frame is the foundation for calculating volatility and average returns. Now, we'll calculate the average daily return and daily volatility, standard deviation, for each asset. Download the code on OnePageCode Substack. The code snippet method on code snippet gives us the average daily return for each stock, while code snippet gives us the daily standard deviation of returns, which is our measure of daily volatility. These are essential inputs for our Sharpe ratio calculation. Approximating the risk-free rate. For the risk-free rate, A common proxy is the yield on a short-term U.S. Treasury bill, e.g., 3-month T-bill. You can find current and historical rates from sources like the U.S. Department of the Treasury or the Federal Reserve. For simplicity in this example, we'll use a fixed annual rate. Download the code on OnePageCode Substack. Here, we're setting in code snippet. In a production environment, this would ideally be fetched dynamically from a reliable source like Federal Reserve Economic Data, or a financial data provider to ensure accuracy over the specific analysis period. Annualizing metrics for Sharpe ratio calculation. Since our code snippet and code snippet are daily figures, and our code snippet is annual, we need to annualize the daily metrics to ensure consistency. Download the code on OnePageCode Substack. We multiply the code snippet by code snippet 252 to get code snippet. For code snippet, we multiply by code snippet to get code snippet. This step ensures all components are on an annual basis before calculating the Sharpe ratio, which is standard practice. Calculating Sharpe ratios for multiple assets and presenting results. Now we can apply our code snippet function to each asset using the annualized metrics. We'll store the results in a pandas data frame for clear comparison. Download the code on OnePageCode Substack. We first create a pandas data frame to hold the code snippet and code snippet. Then, we iterate through each asset, ticker, in the data frame's index, calling our code snippet function with the respective annualized return, volatility, and the global code snippet. The calculated Sharpe ratios are added as a new column, and the data frame is SOAR. TED to easily identify assets with higher Sharpe ratios. This structure output makes comparison straightforward. Interpreting the Sharpe ratio. A higher Sharpe ratio is generally desirable, as it indicates that an investment is providing more return for each unit of risk taken. Sharpe ratio greater than 1.0, generally considered good, indicating a return significantly exceeding the risk-free rate for the risk taken. Sharpe ratio greater than 2.0, very good, indicating excellent risk-adjusted performance. Sharpe ratio greater than 3.0, exceptional. However, what constitutes a good Sharpe ratio can vary significantly depending on the asset class, market conditions, and the time period analyzed. For instance, a Sharpe ratio of 0.5 might be acceptable for a bond portfolio, while a stock portfolio might aim for 1.0 or higher. During periods of high market volatility or economic downturns, even a positive Sharpe ratio might be considered good. It's always best to compare an investment's Sharpe ratio against its peers or relevant benchmarks over the same period. The Sharpe ratio helps differentiate between an investment that simply has high returns, potentially due to high risk, and one that generates superior returns relative to the risk it assumes. For example, if portfolio A has an annual return of 20% and volatility of 25%, and portfolio B has an annual return of 15% and volatility of 10%, with a 2% risk-free rate. Sharpe A equals 0.20 to 0.02 slash 0.25 is equal to 0.72. Sharpe E equals 0.15 to 0.02 slash 0.10 is equal to 1.30. In his scenario, portfolio B, despite having lower absolute returns, offers a significantly better risk-adjusted return as indicated by its higher Sharpe ratio. This is because it delivers a much larger excess return for each unit of risk. Limitations of the Sharpe ratio. While widely used, the Sharpe ratio has several important limitations that investors and analysts should be aware of. 1. Assumes normally distributed returns. The Sharpe ratio uses standard deviation as its measure of risk. Standard deviation is most effective when returns are normally distributed, bell-shaped curve. However, financial returns often exhibit fat tails, more extreme events than a normal distribution would predict, and skewness, asymmetric distribution. In such cases, standard deviation might not fully capture the true risk, especially downside risk. 2. Treats all volatility as bad risk. The Sharpe ratio penalizes both upside and downside volatility equally. Investors, however, typically welcome upside volatility, large positive returns, and are primarily concerned with downside volatility, large negative returns. Metrics like the Sortino ratio address this by focusing only on downside deviation. 3. Sensitivity to the risk-free rate. The choice of the risk-free rate can significantly impact the Sharpe ratio. Small changes in this benchmark can alter the ranking of investments, especially when comparing portfolios with similar risk-adjusted returns. 4. Static measure. The Sharpe ratio prof. It's a snapshot of performance over a specific period. It doesn't account for dynamic changes in risk or return profiles over time. A high Sharpe ratio in a bull market might not translate to similar performance during a bear market. 5. Manipulation. The Sharpe ratio can sometimes be manipulated. For example, smoothing returns, e.g., by valuing illiquid assets less frequently, can artificially lower volatility and thus inflate the Sharpe ratio. Also, selecting a specific historical period, look-back window, can influence the outcome. Beyond Sharpe, other risk-adjusted performance metrics. Brief introduction. Given the limitations of the Sharpe ratio, other metrics have been developed to provide alternative perspectives on risk-adjusted performance. Sortino ratio. Similar to the Sharpe ratio, but it uses downside deviation, standard deviation of only negative returns, in the denominator instead of total standard deviation. This addresses the limitation of treating all volatility equally, focusing specifically on unwanted downside risk. Trainer ratio. This ratio measures excess return per unit of systematic risk, market risk, as measured by beta, $/beta $. It's particularly useful for diversified portfolios, as it assumes unsystematic, specific risk has been diversified away. Jensen's alpha, $/alpha alpha, measures the excess return of a portfolio relative to the return predicted by its beta, given the market return and the risk-free rate. It indicates the value add D by the portfolio manager's skill. While these metrics offer valuable insights, the Sharpe ratio remains a cornerstone of financial analysis due to its simplicity, broad applicability, and intuitive interpretation. Visualizing Sharpe ratios. Visualizing the Sharpe ratios can make comparisons even clearer. A simple bar chart is effective for this purpose. Download the code on OnePageCode Substack. This code block generates a bar chart using Matplotlib. It plots the code snippet for each asset from our code snippet. Titles, labels, and rotated x-axis ticks enhance readability. Importantly, code snippet is used to add the numerical Sharpe ratio values directly on top of each bar, providing immediate quantitative insight alongside the visual comparison. The code snippet command helps ensure all elements fit within the figure area. This visualization quickly highlights which assets offered the best risk-adjusted returns during the analyzed period. Working with stock price data. To transition from theoretical concepts of risk and return to practical application, we must first acquire and prepare real-world financial data. This section focuses on the essential steps of downloading historical stock price data, cleaning it, and transforming it into a format suitable for calculating returns and subsequent risk analysis. Acquiring historical stock data with code snippet. One of the most convenient and widely used Python libraries for downloading historical financial data is Code Snippet. It provides a clean interface to access data from Yahoo Finance, a popular source for freely available stock market information. We begin by importing the necessary libraries: Code Snippet for data acquisition and Code Snippet for data manipulation. Download the code on OnePageCode Substack. With the libraries imported, we can now download historical price data for specific stock tickers. The code snippet function is central to this process. It allows us to specify a list of tickers, a start date, and an end date, or omit the end date to download data up to the current day. For our example, we will download data for Apple, APL, and Google, GOG, starting from January 1st, 2020. Download the code on OnePageCode Substack. The code snippet data frame, returned by code snippet, is a multi-level data frame. This means its columns have multiple levels of indexing. In this case, the top level indicates the price type, e.g. open, high, low, close, ADJ close, volume, and the second level indicates the specific ticker symbol, e.g. Apple, Google. This structure is efficient for storing data from multiple assets, but requires careful indexing to access specific information. Understanding and selecting adjusted close prices. When analyzing financial data, choosing the correct price series is crucial. The code snippet function provides several price types: open, high, low, close, and ADJ close. Open, high, low, close. These represent the actual trading prices at the opening, highest, lowest, and closing points of a trading day. ADJ close. Adjusted close. This is the closing price adjusted for corporate actions such as stock splits, dividends, and new stock offerings. For instance, if a stock pays a dividend, the ADJ close price is reduced by the dividend amount to reflect that the stock price typically drops by the dividend value on the ex-dividend date. Similarly, stock splits, e.g., a 2-for-1 split, cause the price to halve and the number of shares to double. The ADJ close price retrospectively adjusts all historical prices to account for this change, ensuring a continuous and comparable price series. For calculating returns and performing long-term performance analysis, the ADJ close price is almost always the preferred choice. It provides the most accurate reflection of the total return an investor would have received, assuming all distributions like dividends were reinvested. Using close prices without adjustment can lead to inaccurate return calculations, especially over extended periods or for dividend-paying stocks. To prepare our data for return calculations, we need to extract only the ADJ close prices for all our tickers from the multi-level code snippet data frame. Download the code on OnePageCode Substack. Now, Code Snippet is a cleaner data frame where each column represents the ADJ close price series for a specific stock, indexed by date. Cleaning and formatting the data. The Code Snippet data frame has a code snippet, which includes time information, though often set to midnight for daily data. For many financial analyses, especially those focusing on daily periods, having just the date is sufficient and can simplify operations. We can convert the code snippet to a simpler code snippet by accessing the code snippet attribute of the index. While this loses potential time zone or exact time information, for daily adjusted close prices, it's typically a benign simplification. If intraday data or precise time zone handling were critical, more sophisticated methods would be required. Download the code on OnePageCode Substack. Calculating daily returns. With the adjusted close prices prepared, the next crucial step is to calculate the daily returns. Returns are fundamental in finance, as they quantify the percentage change in an asset's price over a specific period. For daily returns, we are interested in the percentage change from each trading day's closing price to the next. The formula for a single period return $RT is $RT equals .PT1/PT $1, where $.$ is the price at time $T and $P $1 is the price at time $T $1. Pandas provides a highly efficient method for this calculation. Code snippet. When applied to a series or data frame, code snippet computes the percentage change between the current and a prior element. By default, it calculates the change relative to the immediately preceding row. Download the code on OnePageCode Substack. You'll notice that the first row of the code snippet data frame contains code snippet, not a number, values. This is expected and correct. Since the code snippet method calculates the change relative to the previous value, there is no previous value for the very first data point in the series, hence code snippet. These code snippet values must be handled before performing statistical calculations. The most common approach for this specific scenario is to simply drop the rows containing code snippet values. Download the code on OnePageCode Substack. By using code snippet, we ensure that all subsequent calculations are performed on valid numerical data, preventing errors and ensuring accuracy. The code snippet data frame is now ready for quantitative analysis, applying risk and return metrics to real data. With our code snippet data frame, we can now apply the risk and return metrics introduced in previous sections to real-world stock data. This directly X the theoretical concepts to practical application. Mean daily return. The mean daily return represents the average percentage change in the stock's price over the period. It gives us an idea of the stock's typical daily performance. Download the code on OnePageCode Substack. These values represent the average daily growth or decline of each stock. For example, a mean daily return of 0.001 implies an average daily increase of 0.1%. Daily volatility, standard deviation. Volatility, as measured by standard deviation, quantifies the dispersion of returns around their mean. A higher standard deviation indicates greater price fluctuations and thus higher risk. Download the code on OnePageCode Substack. Comparing the daily volatility for Apple and Google provides insight into their relative risk profiles during the observed period. A stock with a higher daily volatility experienced larger swings in its daily returns. Annualizing metrics. Daily returns and volatility are useful for short-term analysis, but for long-term investment decisions, it's common practice to annualize these metrics. This allows for a more direct comparison of assets over a standard one-year period. For daily data, the common annualization factors are mean return, multiplied by the number of trading days in a year, typically 252. Standard deviation, volatility multiplied by the square root of the number of trading days in a year, $/QRT, $252. Download the code on OnePageCode Substack. Annually. Z returns give an estimate of the total return expected over a year, assuming the daily average persists. Annualized volatility provides a comparable measure of risk, indicating the expected range of price fluctuations over a year. Sharpe ratio. The Sharpe ratio is a critical metric for evaluating risk-adjusted return. It measures the excess return above the risk-free rate, per unit of total risk volatility. A higher Sharpe ratio indicates a better risk-adjusted performance. Sharpe ratio equals asset return, risk-free rate, / asset volatility. Let's assume a hypothetical annual risk-free rate of 2%, 0.02, for this period. Download the code on OnePageCode Substack. By comparing the Sharpe ratios of Apple and Google, we can assess which stock delivered more return for the amount of risk taken. A stock with a higher Sharpe ratio is generally considered more attractive from a risk-adjusted performance perspective. Visualizing stock prices and returns. Visualization is an indispensable tool in financial analysis. Plotting price series and return distributions can provide immediate insights into trends, volatility, and potential outliers that might be missed in raw data tables. Plotting adjusted close prices. A line plot of adjusted close prices shows the trend and overall price movement of the stocks over time. Download the code on OnePageCode Substack. This plot allows us to visually compare the growth trajectories of Apple and Google, observing periods of significant gains or declines. Plotting daily returns, histograms. Histograms of daily returns provide insights into the distribution of returns. We can observe if returns are normally distributed, if there are fat tails, more extreme events than a normal distribution would predict, or if the distribution is skewed. Download the code on OnePageCode Substack. These histograms visually confirm the central tendency around zero daily return and the spread volatility of the returns. We can also visually inspect for skewness or kurtosis, which are important characteristics of financial return distributions. Next steps and practical applications. The process of acquiring, cleaning, and transforming raw price data into clean daily returns is a foundational step in quantitative finance. The code snippet data frame is now in a pristine state, ready for a multitude of further analyses and applications, including portfolio construction. The returns data is essential for calculating portfolio returns, volatility, and diversification benefits when combining multiple assets. Risk management. Understanding individual asset volatility and correlation, which can be calculated from these returns, is critical for managing portfolio risk. Backtesting trading strategies. Prepared returns data is used to simulate the performance of various trading algorithms or investment strategies over historical periods. Factor analysis. Researchers use returns data to identify and test factors that explain asset price movements, VAR, value at risk, and conditional VAR calculations. These advanced risk metrics rely heavily on the distribution of returns. While CodeSnippet conveniently handles non-trading days by only providing data for actual trading days, it's important to be aware that when working with custom datasets or merging data from different sources, explicitly handling missing dates or aligning time series can be necessary. Calculating the mean, variance, and standard deviation. Understanding the central tendency and dispersion of financial returns is fundamental in quantitative finance. The mean provides a measure of expected return, while variance and its square root, standard deviation, often referred to as volatility in finance, quantify the risk or fluctuation around that mean. This section delves into the practical calculation of these statistics for financial asset returns using Python's pandas and NumPy libraries, emphasizing both direct methods and a deeper understanding of their underlying statistical principles. We will assume that you have already loaded and processed stock price data into a pandas data frame and calculated daily or periodic returns, similar to what was covered in the Working with Stock Price Data section. For consistency, let's start by setting up a sample data frame of returns for demonstration purposes. Setting up our returns data. To illustrate the calculations, we'll create a sample pandas data frame representing daily returns for a couple of hypothetical stocks. In a real-world scenario, this code snippet would be generated from historical price data. Download the code on OnePageCode Substack. This code block initializes a pandas data frame named code snippet with 100 days of synthetic daily returns for stock A and stock B. We use code snippet to simulate returns with a specified mean and standard deviation, mimicking the typical characteristics of FINANC. EO return series. This code snippet will be our primary data structure for all subsequent calculations. Calculating mean returns. The mean return represents the average return over a specified period. It's a measure of the central tendency of the returns distribution. In pandas, calculating the mean for each column, i.e., for each stock, is straightforward using the code snippet method. Download the code on OnePageCode Substack. When applied to a data frame, the code snippet method, by default, calculates the mean for each column. In our code snippet, each column represents a stock, so code snippet will show the average daily return for stock A and stock B over the 100-day period. This is a direct measure of the expected return for each asset based on historical data. Calculating standard deviation volatility with built-in functions. Standard deviation is a measure of the dispersion of a set of data points around its mean. In finance, when applied to returns, it is often referred to as volatility. A higher standard deviation indicates greater price fluctuations and thus higher risk. Pandas provides a convenient code snippet method for this calculation. Default column-wise standard deviation code snippet. By default, the code snippet method, like code snippet, operates column-wise code snippet. This calculates the standard deviation for each stock's returns independently. Download the code on OnePageCode Substack. The output code snippet shows the daily standard deviation for stock A and stock B. These values quantify the typical deviation of daily returns from their respective means. For instance, if stock A has a daily volatility of 1%, it implies that its daily returns typically fluctuate around its mean return by about 1%. It's important to note that code snippet is the default behavior for many pandas aggregation methods like code snippet, code snippet, code snippet, code snippet. This means you often don't need to explicitly specify code snippet for column-wise operations, but doing so can improve code clarity. Download the code on OnePageCode Substack. As expected, the result remains the same, reinforcing that code snippet is the default for column-wise operations. Row-wise standard deviation code snippet. While calculating standard deviation for each stock, column-wise, is common, you might also want to understand the dispersion across assets for a given period. This is where code snippet comes into play. Download the code on OnePageCode Substack. When code snippet is specified, code snippet calculates the standard deviation for each row. In the context of our code snippet, this means for each specific day, it calculates the standard deviation of the returns between stock A and stock B. What does code snippet signify in a financial context? This calculation provides a measure of how diversified or undiversified the returns of the two stocks were on a particular day. A high standard deviation on a given D means that stock A and stock B had very different returns on that day, e.g., one was up significantly, the other down significantly. A low standard deviation means their returns were very similar. While less commonly used than asset-specific volatility, it can be useful in portfolio analysis to understand daily relative performance or to identify days where assets behaved very differently from each other. Manual calculation of variance and standard deviation. While built-in functions are convenient, understanding the underlying mathematical formulas is crucial for a deeper grasp of these concepts. Let's manually calculate variance and standard deviation from first principles. The formula for population variance, $sigma(2) is $sigma стрижка 2 ровно фрац левозложена затворка, сум левозложена затворка и ровно 1 правозложена затворка стрижка левозложена затворка n правозложена затворка 11 му стрижка 2 правозложена затворка левозложена затворка n правозложена затворка $. Where $11 are individual data points, $mu$ is the population mean, and $and is the total number of observations. The formula for population standard deviation, $sigma$, is simply the square root of the population variance. $sigma equals $sqrt $sigma(2). Let's apply these steps. 1. Calculate deviations from the mean. Subtract the mean return of each stock from its respective daily returns. 2. Square the deviations. Square each deviation to ensure all values are non-negative and to penalize larger deviations more heavily. 3. Sum the square deviations. Sum these square deviations for each stock. 4. Divide by n. Divide the sum by the total number of observations, code snippet, to get the popula. Tie in variance. 5. Take the square root. Take the square root of the variance to get the standard deviation. Download the code on OnePageCode Substack. This step calculates how much each daily return for stock A deviates from stock A's average return, and similarly for stock B. The result is a data frame of the same shape as code snippet, but with values centered around 0. Download the code on OnePageCode Substack. Squaring the deviations ensures that both positive and negative deviations contribute positively to the measure of dispersion. It also amplifies larger deviations, giving them more weight. Download the code on OnePageCode Substack. This step completes the variance calculation based on the population formula. Code snippet gives us code snippet, the total number of daily observations. We sum the square deviations for each stock, column-wise, and then divide by code snippet. Download the code on OnePageCode Substack. Finally, taking the square root of the manually calculated population variance yields the population standard deviation. Now, let's compare our manual population standard deviation with the result from Panda's built-in code snippet method. Download the code on OnePageCode Substack. You'll notice a slight difference between the manual population standard deviation and the result from code snippet. This discrepancy is crucial and leads us to the distinction between population and sample statistics. The crucial distinction: population versus sample. Standard deviation. The difference observed above arises because Panda's code snippet method, by default, calculates the sample standard deviation, not the population standard deviation. The formula for sample variance, $(2) is $(2) equals \frac sum I equals 111 \bar x $2 $1. Where $11 are individual data points, bar x is the sample mean, and $and is the sample size. The formula for sample standard deviation, is equals $sqrt square $. The key difference is the denominator. $N for population variance, and $N, $1 for sample variance. This $N, $1 correction is known as Bessel's correction. Why $N, $1 Bessel's correction? When we calculate statistics from a sample, a subset of the entire population, the sample mean $\bar $, is used as an estimate for the true population mean $\mu$. However, the sample mean is, by definition, the mean of that specific sample, and the data points in the sample are generally closer to their own sample mean than they are to the true, unknown population mean. If we were to divide by $and when using the sample mean, our estimate of the variance would tend to be underestimated, biased. Dividing by $N, $1 corrects this bias, providing an unbiased estimator of the population variance from sample. In financial analysis, we almost always work with samples, e.g., historical returns are just a sample of all possible returns an asset could ever generate. So using the sample standard deviation with Bessel's correction is a standard PR. Actice. Let's recalculate our manual standard deviation using the $N, $1 denominator. Download the code on OnePageCode Substack. Now, comparing this manual sample standard deviation with the Pandas built-in code snippet. Download the code on OnePageCode Substack. You should now see that the results match. This confirms that Pandas code snippet method and code snippet uses $N, $1 as the default degrees of freedom, making it an unbiased estimator for the population standard deviation when working with samples. Using the code snippet parameter in Pandas. Pandas code snippet and code snippet methods provide a code snippet delta degrees of freedom parameter that allows you to explicitly control the denominator. Code snippet uses $and in the denominator, population standard deviation / variance. Code snippet uses $N, $1 in the denominator, sample standard deviation / variance, which is the default. Let's confirm this using the code snippet parameter. Download the code on OnePageCode Substack. As you can see, setting code snippet explicitly yields the population standard deviation, matching our first manual calculation. Setting code snippet, or omitting it, yields the sample standard deviation, matching our second manual calculation and confirming the default behavior. A final verification step, taking the square root of the sample variance, should indeed equal the sample standard deviation. Download the code on OnePageCode Substack. This confirms the consistency between variance and standard deviation calculations in Pandas. Practical implications and further use. The mean return and standard deviation are fundamental building blocks in quantitative finance. Quantifying risk and return. These two metrics directly quantify the central tendency, mean return, and dispersion, volatility/risk, of financial asset returns. They're the primary inputs for comparing the risk-return profiles of different stocks or investment vehicles. A higher mean return for a given level of volatility is generally preferred. Input for other metrics. Sharpe ratio. As discussed in a previous section, the Sharpe ratio combines these two elements to evaluate risk-adjusted performance. The mean return, minus the risk-free rate, is divided by the standard deviation, volatility, to give a standardized measure of return per unit of risk. The daily standard deviation calculated here would typically be annualized before being used in the Sharpe ratio calculation for annual returns. Annualizing volatility. While we calculated daily standard deviation, financial risk is often expressed on an annual basis. The annualizing volatility section details how to convert daily volatility to annual volatility, typically by multiplying by the square root of the number of trading days in year, e.g., $/QRT $252. Risk management and portfolio construction. Understanding the individual volatilities of assets is crucial for constructing diversified portfolios. Modern portfolio, the ORI, for instance, heavily relies on these statistics alongside correlations between assets to optimize portfolios for a desired level of risk and return. Performance benchmarking. Mean and standard deviation allow investors and analysts to compare the performance and risk of an asset or portfolio against a benchmark, e.g., an index like the S&P 500. By mastering the calculation and interpretation of mean, variance, and standard deviation, you gain essential tools for analyzing financial data and making informed quantitative decisions. Calculating the annualized volatility. Financial analysis often requires comparing the risk of different assets or strategies. However, the standard deviation we calculate is dependent on the time period over which returns are observed, e.g., daily, weekly, monthly. To make meaningful comparisons, we need a standardized measure of risk, and the most common standard is annualized volatility. Annualized volatility projects the single-period volatility, like daily standard deviation, to an annual basis, allowing for an apples-to-apples comparison of risk across different assets, regardless of the frequency of their underlying return data. The volatility annualization formula. The formula for annualizing volatility is straightforward. $sigma annual equals \sigma period times $, where $sigma annual $ is the annualized volatility. $sigma period $ is the standard deviation of returns for a single period, e.g., daily standard deviation, monthly standard deviation. $T$ is the number of periods in a year. For daily returns, $T$ is typically 252, representing the approximate number of trading days in a year. For monthly returns, $T$ would be 12. For quarterly returns, $T$ would be 4. Why the square root of time? A common question is why volatility scales with the square root of time, rather than linearly like returns. If you have an average daily return, you can simply multiply it by 252 to get an approximate annual return. However, this is not the case for volatility. Imagine a stock price moving randomly. The total deviation, volatility, from its starting point after a certain time isn't simply the sum of daily deviations. Think of it like a random walk. The further you walk, the more likely you are to be away from your starting point, but the accumulated dispersion grows slower than the number of steps. Mathematically, this is because standard deviation measures dispersion, and for independent random variables, variances, standard deviation squared, are additive. Since $sigma 2 annual equals T times sigma 2 period $, taking the square root of both sides gives $sigma annual equals times sigma period $. This relationship holds under the assumption that returns are independent and identically distributed, ID, over time, and approximately follow a normal distribution. While real-world returns are not perfectly IID or normal, this approximation is widely used in finance for its practical utility. Implementing annualized volatility in Python. We will now apply this formula using Python, building upon the daily returns and standard deviation calculations from previous sections. For demonstration purposes, we will assume code snippet is a pandas data frame containing daily returns for various assets. First, let's ensure we have a code snippet to work with. If you're following along directly from previous sections, you likely already have this. If not, here's a small setup for a dummy data frame. Download the code on OnePajek. Substack. This code block sets up a sample code snippet with 252 daily returns for Apple and Google, simulating typical daily return characteristics. This ensures our subsequent calculations have data to operate on. Next, we calculate the daily standard deviation of these returns, which serves as our code snippet. Download the code on OnePajek Substack. The code snippet method on the data frame automatically calculates the standard deviation for each column, asset, returning a pandas series. This code snippet is the $sigma period $ component of our formula. Now, we can annualize these daily standard deviations. As discussed, for daily returns, the number of periods in a year, code snippet, is conventionally taken as 252, representing the average number of trading days. Download the code on OnePajek Substack. Here, we import code snippet to use its code snippet function. We multiply the code snippet series by code snippet. Pandas handles the element-wise multiplication automatically, resulting in a new series where each asset's daily volatility has been annualized. The value code snippet is a standard convention, representing approximately the number of trading days in a typical year, excluding weekends and major holidays. An alternative way to calculate the square root is by raising a number to the power of 0.5 using the exponentiation operator, code snippet. Download the code on one patch code Substack. Both code snippet and code snippet yield identical results, providing flexibility in how you express the calculation. The choice between them is often a matter of personal preference or coding style. Encapsulating annualization logic into a function. To promote code reusability and make our calculations more modular, it's good practice to encapsulate the annualization logic within a Python function. This allows us to easily annualize volatility from any period, daily, monthly, quarterly, by simply passing the correct code snippet argument. Download the code on one patch code Substack. This code snippet function takes two arguments: code snippet, which would be a single float or a panda series, and code snippet. It then applies the standard formula and returns the annualized value. Let's use this function to recalculate our daily annualized volatility. Download the code on one patch code Substack. As expected, the results are identical to our previous direct calculations, demonstrating the function's correct implementation. Annualizing volatility from different frequencies. The power of the code snippet function becomes clear when dealing with different return frequencies. The same formula applies, only the code snippet changes. Let's simulate monthly and quarterly returns and annualize their volatilities. In a real-world scenario, you would obtain these by aggregating your daily returns, e.g., using code snippet and code snippet or code snippet for returns, then calculating standard deviation. Download the code on one patch code Substack. CK. For monthly returns, we set code snippet to 12. The code snippet function then correctly scales the monthly standard deviation to an annual figure. Download the code on one patch code Substack. Similarly, for quarterly returns, we set code snippet to 4. This demonstrates the versatility of the annualization formula and our custom function across different return frequencies. Interpreting annualized volatility. Let's revisit the annualized volatilities calculated from our daily returns for Apple and Google. Download the code on one patch code Substack. Using the dummy data generated for this section, you might see results similar to. Download the code on one patch code Substack. Note, your exact numbers will vary slightly if you did not use the same code snippet or if the actual data from prior sections differs. If, for example, AAPL's annualized volatility is approximately 0.238 or 23.8%, and GOOG's is approximately 0.317 or 31.7%. This implies that over a year, GOOG's returns are expected to fluctuate more widely around their average than AAPL's returns, assuming the underlying daily return patterns continue. In simpler terms, Google has been historically riskier than Apple based on this specific period's data. Annualized volatility is a critical metric for risk comparison. It allows investors and traders to compare the inherent risk of different assets or portfolios on a standardized annual basis. Portfolio management. It's a key input for portfolio optimization models, E.G. Modern portfolio theory. Risk-adjusted performance. It is the denominator in many risk-adjusted return metrics, such as the Sharpe ratio, which we discussed previously. A higher annualized volatility generally means a higher level of uncertainty or risk associated with an investment. Calculating the annualized returns. When evaluating investment performance, it's crucial to standardize metrics to allow for fair comparisons across different time horizons. A strategy that generates 1% in a day cannot be directly compared to one that generates 1% in a month without adjusting for the time period. This is where annualization becomes essential. Annualized returns provide a common basis, a yearly rate, for comparing investments regardless of their observation frequency, daily, weekly, monthly, etc. The importance of geometric mean for compounding returns. Before diving into annualization, we must first understand how to correctly average returns over multiple periods. There are two primary types of averages, the arithmetic mean and the geometric mean. While the arithmetic mean is suitable for forecasting the return of a single future period, the geometric mean is the correct average to use when calculating the average growth rate of an investment over multiple periods, especially when returns are compounded. Arithmetic mean versus geometric mean, a conceptual difference. The arithmetic mean is simply the sum of returns divided by the number of periods. For example, if an investment returns plus 10% in year 1 and minus 5% in year 2, the arithmetic mean is $0.10 plus minus 0.05 slash 2 equals $0.025 or 2.5%. This suggests an average annual return of 2.5%. However, let's track the actual wealth. Start with $100. Year 1, $100, 1 plus 0.10 equals $110. Year 2, $110, 1 to 0.05 equals $104.50. The actual growth over 2 years is from $100 to $104.50, which is a 4.5% total return. To find the average annual growth rate that would result in $104.50 from $100 over 2 years, we need a rate code snippet such that $1 plus R, caret 2 equals 104.50 slash $100. Solving for code snippet gives us the geometric mean. The geometric mean accounts for the effect of compounding, where returns in subsequent periods are earned on the principal plus accumulated returns from previous periods. It represents the constant annual rate of return that would yield the same cumulative return over the investment period. The formula for the geometric mean return, $RG$, for a series of return $R1, R2, R in dollar is $RG égale 1 plus R1, 1 plus R2, 1 plus Rn, 1 ou $1. Let's apply this to our example. $RG égale 1 plus 0.10, 1 à 0.05, 1 demi ou $1. $RG equals 1.100.95, caret 1 half, $1. $RG equals 1.045, caret 1 half, $1. $RG backslash approximate 1.0222 to 1 backslash approximate $0.0222 or 2.22%. Notice that 2.22% geometric mean is less than 2.5% arithmetic mean. This is a general rule. The geometric mean will always be less than or equal to the arithmetic mean, with the difference increasing with the volatility of the returns. For investment performance, the geometric mean provides a more accurate picture of the actual average growth rate of capital. Illustrating geometric mean with Python. Let's use a simple numerical example to demonstrate the calculation of the geometric mean in Python. We'll compare it directly to the arithmetic mean. Download the code on Epic Code Substack. This code snippet initializes a Panda series with 3 hypothetical daily returns. This small dataset will allow us to manually verify the calculations. Next, we'll calculate the arithmetic mean. Download the code on OnePageCode Substack. The arithmetic mean is straightforward and gives us a simple average of the daily returns. However, it doesn't account for compounding. Now, let's calculate the geometric mean step by step. The first step involves converting the returns to the code snippet format, also known as growth factors or return relatives. Download the code on OnePageCode Substack. The code snippet format is crucial because it allows us to multiply the returns together to reflect compounding. A 5% return means your capital grows by a factor of 1.05. Next, we calculate the product of these growth factors to find the cumulative growth over the period. Download the code on OnePageCode Substack. The code snippet method from Pandas, or number py, efficiently calculates the product of all elements in the series. This code snippet factor tells us how much $1 invested initially would have grown to over the 3 days. Finally, we apply the geometric mean formula. Download the code on OnePageCode Substack. Here, code snippet calculates the nth root, which is the inverse of compounding. Subtracting 1 converts this average growth factor back into a return. Notice how the geometric mean is slightly lower than the arithmetic mean, reflecting the actual compu. Dead average growth. The annualization process. Annualization is the process of converting a return over a specific period, e.g., daily, monthly, into an equivalent annual return. This is done by compounding the geometric mean of a shorter period's return over the number of such periods in a year. The general formula for annualizing a periodic return is annualized równa się 1 plus in u $1 amerykański, where $R periodic dollar is the geometric mean return for the shorter period, e.g., daily geometric mean return. Dollar and dollar is the number of periods in a year, e.g., 252 trading days for daily returns, 12 for monthly returns, 4 for quarterly returns. This formula assumes discrete compounding, meaning returns are calculated and added to the principal at the end of each period. This is the most common approach in finance for reported returns. In contrast, continuous compounding uses the exponential function code snippet, often used in theoretical models or for very short, continuously rebalanced periods. Annualization factors, 252 versus 365 days. A common point of confusion is whether to use 252 or 365 days for annualization. 252 trading days. This is the standard for annualizing returns and volatility for financial assets like stocks, bonds, and ETFs that trade on exchanges. It represents the approximate number of days the markets are open in a year, excluding weekends and holidays. Using 252 days reflects the actual opportunities for price movements. 365 calendar days. This FAC. TOR is appropriate for assets that can generate returns every day of the year, such as real estate investments, private equity funds, or certain commodities. It's also used for interest rates that compound daily regardless of market holidays. For public market data, 252 trading days is almost always the correct choice for annualizing returns and volatility. Calculating annualized returns in Python with real data. Let's assume we have a pandas data frame code snippet containing daily percentage returns for one or more assets. This data frame would typically be generated from previous sections, such as calculating daily percentage changes from adjusted close prices. First, let's set up a sample code snippet for demonstration purposes. Download the code on OnePageCode Substack. This sets up a data frame code snippet similar to what you'd have after calculating daily percentage changes. The code snippet ensures we generate business days, aligning with our 252-day annualization factor. Method 1. Calculate geometric mean daily return, then annualize. This method explicitly follows the two-step process. First, find the geometric mean daily return, then compound it over the year. Download the code on OnePageCode Substack. Here, code snippet gives us the number of rows, i.e., the number of daily periods. We use code snippet because code snippet is a series even if code snippet has one column. Now, we annualize this geometric mean daily return using the 252 trading days factor. Load the code on OnePageCode Substack. This calculation directly applies the annualization formula using the geometric mean daily return we just computed. Method 2. Direct annualization from cumulative product the faster way. This method combines the steps into a single, more concise formula. It leverages the fact that code snippet is the geometric mean growth factor, which can then be raised to the power of code snippet to achieve the total annual growth factor. The formula is $R annualized equals 1 plus R1, 1 plus R2, 1 plus Rn, caret annualization factor slash $1, where $, and dollar is the number of periods in your code snippet. Download the code on OnePageCode Substack. Both methods yield the same result, but the second method is often preferred for its conciseness and efficiency in code. The exponent code snippet effectively scales the total observed growth factor to an annual basis. For example, If you have 6 months of daily data, code snippet is approximate 126, then code snippet. This means you're squaring the 6-month growth factor to project a full year's growth. Modularizing the annualization calculation. To make our code reusable and robust, it's good practice to encapsulate the annualization logic within a function. This function can then be used for different assets and different return frequencies. Download the code on OnePageCode Substack. This function code snippet is flexible and can handle any frequency of returns as long as the correct code snippet is provided. Handling different frequencies. Let's demonstrate how to use the code snippet function with different return frequencies. Download the code on OnePageCode Substack. This example showcases the versatility of the code snippet function, allowing you to standardize performance across various reporting frequencies. Annualizing returns for multiple assets simultaneously. Often, you'll have a data frame with returns for multiple assets. Pandas allows for efficient, vectorized operations, so our code snippet function can be easily adapted or applied using data frame methods. Download the code on OnePageCode Substack. By applying the code snippet and code snippet operations directly on the data frame, Pandas automatically performs these calculations column-wise, making it incredibly efficient to annualize returns for many assets at once. The result code snippet is a Panda series where each element is the annualized return for the corresponding asset, connecting to risk-adjusted performance. Calculating annualized returns is a fundamental step in evaluating investment performance. It allows for a standardized comparison of returns across different investments and strategies. Crucially, it forms one half of risk-adjusted performance metrics like the Sharpe ratio. The Sharpe ratio, covered in detail in a subsequent section, measures the excess return per unit of risk. It is typically calculated as $text Sharpe ratio equals \frac RP RF \sigmap where $RP is the annualized portfolio return, which we just calculated. $RF is the annualized risk-free rate. $sigmap is the annualized portfolio volatility, standard deviation of returns, as calculated in the Calculating the Annualized Volatility section. By having both annualized returns and annualized volatility, you are well equipped to calculate and interpret the Sharpe ratio, providing a comprehensive view of an investment's performance relative to its risk. For instance, if you have calculated the annualized volatility for asset returns from the previous section, you can now combine it with code snippet to get its Sharpe ratio. Download the code on OnePageCode Substack. This demonstrates how the annualized return is a direct input into such critical performance metrics, highlighting its practical application in quantitative finance. Calculating the Sharpe ratio. The Sharpe ratio, developed by Nobel laureate William F. Sharpe, is a cornerstone metric in quantitative finance for evaluating the risk-adjusted return of an investment. It measures the excess return, or risk premium, an investment provides per unit of total risk. Essentially, it helps investors understand if the returns they are earning are commensurate with the level of risk they are taking. A higher Sharpe ratio indicates better risk-adjusted performance. Understanding the components of the Sharpe ratio. The formula for the Sharpe ratio is $text Sharpe ratio equals \frac text annualized return \text risk-free rate \text annualized volatility $. Let's break down each component. Annualized return. This is the total return generated by the investment over a year. As covered in the Calculating the Annualized Returns section, it's crucial to use the geometric mean for compounding returns to accurately reflect the true growth of an investment over time. For the purpose of the Sharpe ratio, this represents the reward component of our investment. Risk-free rate. This is the theoretical rate of return of an investment with zero risk. In practice, this is often approximated by the yield on short-term government securities, such as U.S. Treasury bills, e.g., 3-month or 1-year T-bills. A common practice is to use the current yield on a 3-month Treasury bill. The risk-free rate serves as a baseline. Any return above this rate is considered excess return or risk premium, because it compensates the investor for taking on risk. Annualized volatility. This represents the total risk of the investment measured by the standard deviation of its returns, annualized. As discussed in the Calculating the Annualized Volatility section, volatility quantifies the degree of variation or fluctuation in an asset's returns. In the context of a Sharpe ratio, it serves as the denominator, penalizing investments that achieve high returns through excessive risk-taking. The concept of excess return. The numerator of a Sharpe ratio, code snippet, is known as the excess return. This value is critical because it isolates the return generated by taking on risk above and beyond what could be earned from a risk-free asset. An investment should ideally generate an excess return to justify the risk. If an investment's return is less than or equal to the risk-free rate, its Sharpe ratio will be 0 or negative, indicating that the investor is not being adequately compensated for the risk taken. Calculating the Sharpe ratio in Python. For our calculation, we will use the code snippet and code snippet values derived in previous sections. These values are typically represented as pandas series, allowing for element-wise operations across multiple assets. Let's assume we have the following annualized return and volatility data for Apple, APL, and Google, GOG, from our previous calculations. Download the code on one-page code S. Upstack. The code above initializes two panda series, code snippet and code snippet, with hypothetical values for Apple, APL, and Google, GOG. These are the inputs to our Sharpe ratio calculation, simulating the output from the Calculating the Annualized Returns and Calculating the Annualized Volatility sections. Next, we define our code snippet. For demonstration, we'll use a common proxy like the yield on a short-term treasury bill, often expressed as a decimal. Download the code on one-page code Substack. Here, we set the code snippet to 0.03, representing 3%. This rate will be subtracted from the code snippet to determine the excess return. Now, we calculate the code snippet by subtracting the code snippet from the code snippet. Since code snippet is a pandas series, this operation is performed element-wise for each stock. Download the code on one-page code Substack. The code snippet series shows how much return each stock generated above the risk-free rate. For Apple, it's 22%, 0.25 to 0.03, and for Google, it's 7%, 0.10 to 0.03. Finally, we calculate the Sharpe ratio by dividing the code snippet by the code snippet. Again, due to the nature of pandas series, this division is performed element-wise. Download the code on one-page code Substack. The code snippet series provides the final risk-adjusted performance metric for each stock. For Apple, the Sharpe ratio is approximately 1.46, 0.22/0.15. And for Google, it's approximately 0.50, 0.07/0.14. Encapsulating. The calculation in a function. To promote modularity and reusability, it's good practice to encapsulate the Sharpe ratio calculation within a Python function. This makes the code cleaner, easier to test, and allows for consistent application across different datasets. Download the code on one-page code Substack. The code snippet function takes the annualized returns, volatilities, and risk-free rate as inputs. It includes basic error handling to prevent division by 0 if volatility is somehow 0. It then performs the same code snippet and code snippet calculations and returns the result as a pandas series. This function can now be easily called whenever you need to compute Sharpe ratios. Interpreting the Sharpe ratio. The calculated Sharpe ratios, e.g., Apple, 1.46, Google, 0.50, provide valuable insights. Comparison. A higher Sharpe ratio indicates that an investment is providing more return per unit of risk. In our example, Apple, APL, with a Sharpe ratio of 1.46 significantly outperforms Google, GOG, with a Sharpe ratio of 0.50 on a risk-adjusted basis. This means Apple generated more excess return for the amount of volatility it exhibited compared to Google. Benchmarking. Sharpe ratios can be used to compare an investment's performance against a benchmark portfolio or other investment opportunities. For instance, if an index fund had a Sharpe ratio of 0.8, Apple's performance, 1.46, would be considered superior. Typical ranges. There isn't a universally good Sharpe ratio, as it can vary by asset class, market conditions, and time horizon. However, as a general guideline, less than 1.0. Poor. Returns not commensurate with risk. 1.0 to 1.99. Good. 2.0 to 2.99. Very good. 3.0 plus. Excellent. It's important to note that these are rough guidelines, and the absolute value of the Sharpe ratio should always be considered in context with a specific asset class and market environment. Limitations and considerations of the Sharpe ratio. While the Sharpe ratio is a powerful tool, it's essential to be aware of its limitations. 1. Assumes normal distribution of returns. The Sharpe ratio uses standard deviation as its measure of risk, which is most effective when returns are normally distributed. For investments with non-normal return distributions, e.g., those with significant skewness or fat tails, like hedge funds using option strategies, standard deviation may not fully capture the true risk. In such cases, alternative risk-adjusted metrics like the Sortino ratio, which only considers downside volatility, might be more appropriate. 2. Does not distinguish between upside and downside volatility. Standard deviation treats both positive and negative deviations from the mean equally. Investors, however, are typically more concerned about downside risk, losses, than upside volatility, large gains. 3. Sensitivity to the risk-free rate. The choice of the risk-free rate can significantly impact the Sharpe ratio. Using a rate that is too high or too low, W can distort the true risk-adjusted performance. 4. Can be manipulated. Strategies that smooth returns, e.g., by holding a significant cash position or using certain derivatives, can artificially lower volatility and thus inflate the Sharpe ratio without genuinely reducing risk. 5. Backward-looking. The Sharpe ratio is calculated using historical data, and past performance is not necessarily indicative of future results. Practical applications and beyond. The Sharpe ratio is widely used by portfolio managers to evaluate the performance of their portfolios and make adjustments to asset allocation. Investors to compare different investment opportunities, e.g., mutual funds, ETFs, individual stocks, and select those offering the best risk-adjusted returns. Asset allocators to optimize portfolio construction by finding the combination of assets that maximizes the Sharpe ratio for a given risk tolerance. While the Sharpe ratio is a fundamental metric, it's often used in conjunction with other performance measures, such as the Trainer ratio, which focuses on systematic risk, or beta, and Jensen's alpha, which measures excess return relative to market expectations. Understanding the Sharpe ratio is a crucial step in developing a comprehensive approach to investment analysis and portfolio management. Summary of core concepts in risk and return. This section consolidates the fundamental concepts of risk and return, their calculation, and their application in financial analysis. It serves as a comprehensive review, reinforcing the definitions, relationships, and significance of various financial metrics discussed previously. Mastering these concepts is crucial for evaluating investment opportunities and constructing robust portfolios. Recap of return calculations. Understanding how to measure returns is foundational to financial analysis. We've explored various ways to quantify returns, each serving a specific purpose. Simple returns. Simple returns, often calculated as the percentage change from one period to the next, are straightforward and intuitive. They are additive across assets within a portfolio for a single period, making them useful for cross-sectional analysis. Download the code on OnePageCode Substack. Here, we initialize a Panda series to represent a sequence of asset prices over time. This simple structure allows for easy calculation of period-over-period changes. Download the code on OnePageCode Substack. The code snippet method in Pandas efficiently computes the percentage change between the current and a prior element. We use code snippet to remove the code snippet value generated for the first period, as there's no preceding price to compare against. Simple returns are ideal for analyzing performance over a single, discrete period. Multi-period and terminal returns. The importance of the geometric mean. While simple returns are good for individual periods, calculating returns over multiple periods requires a different approach, especially when considering the effect of compounding. Arithmetic mean versus geometric mean. Arithmetic mean, the sum of returns divided by the number of observations. It's suitable for calculating the average return over a period if you're not reinvesting, e.g., average dividend yield. It can overestimate true investment performance over multiple periods because it doesn't account for compounding. Geometric mean, the average rate of return of a set of values calculated using the product of the terms. It is the statistically correct method for calculating average returns over multiple periods, as it accounts for the compounding effect of returns. This is crucial for understanding the true growth of an investment. Consider a scenario where an asset first gains 10% and then loses 5%. Download the code on OnePageCode Substack. The arithmetic means simply averages the two returns. While useful for some statistical analyses, it doesn't reflect the actual wealth creation. Download the code on OnePageCode Substack. The geometric mean, calculated by taking the nth root of the product of 1 plus r values, accurately reflects the compounded growth rate. For a terminal return, the total return over the entire period, you simply multiply code snippet for each period. Download the code on OnePageCode Subs. Tuck. The code snippet represents the actual total return an investor would achieve by compounding their returns over the specified periods. This distinction between arithmetic and geometric means is a common pitfall. Always use the geometric mean for calculating average compounded returns over time. Understanding volatility and risk. Volatility measures the dispersion of returns around an average, serving as a proxy for risk. Higher volatility implies greater uncertainty and thus higher risk. Standard deviation and variance. The standard deviation is the most common measure of volatility. It quantifies how much the returns deviate from their mean. Its square, variance, is also a measure of dispersion. Sample versus population, standard deviation, N versus N. A critical nuance in calculating standard deviation is the choice of the denominator. Code snippet for a population and code snippet for a sample. Population standard deviation, and used when you have data for every single member of a group, i.e., the entire population. Sample standard deviation, N, one used when you have data for only a subset, a sample, of a larger population. The code snippet in the denominator, Bessel's correction, provides an unbiased estimate of the population variance from a sample. In finance, we almost always work with samples, e.g., historical stock prices are a sample of all possible future prices, so using code snippet is the standard practice. Download the code on OnePageCode Substack. As shown, the code snippet delta degrees of freedom, parameter in pandas and number py, standard deviation calculations controls the denominator. Code snippet, the default, uses code snippet, while code snippet uses code snippet. For financial time series analysis, code snippet is almost always the correct choice. Annualizing volatility. To compare the risk of assets over different time horizons, volatility is annualized. This involves scaling the periodic standard deviation by the square root of the number of periods in a year. Download the code on OnePageCode Substack. The annualization factor for volatility is code snippet, where code snippet is the number of periods per year, e.g., 252 for daily, 52 for weekly, 12 for monthly. Assumptions for annualization. The annualization of volatility relies on key assumptions. Independence. Returns in each period are independent of returns in other periods. Identically distributed. Returns in each period are drawn from the same probability distribution. Stationarity. The mean and variance of returns do not change over time. Normal distribution. Often implicitly assumed, though not strictly required for the mathematical scaling. It simplifies interpretation. In reality, these assumptions are often violated, e.g., volatility clustering, fat tails, which means annualized volatility is an estimate and should be interpreted with caution. However, it remains a standard and useful metric for comparison. The risk-return trade-off. A cornerstone of investment theory is the risk-return trade-off, which posits that higher potential returns typically come with higher levels of risk. Investors must decide how much risk they are willing to bear in pursuit of higher returns. Low risk, low return. Assets like government bonds or money market funds generally offer lower returns but also exhibit lower volatility. High risk, high return. Assets like individual stocks or emerging market investments can offer significantly higher returns but also carry greater potential for losses and higher volatility. Understanding this trade-off is critical for aligning investment choices with an investor's individual risk tolerance and financial objectives. There is no one-size-fits-all investment. The optimal choice depends on the investor's specific circumstances. Risk-adjusted performance, the Sharpe ratio. While analyzing returns and risk separately is informative, the Sharpe ratio provides a single metric to evaluate an investment's return per unit of risk. It's a measure of risk-adjusted return. The formula for the Sharpe ratio is $/text Sharpe ratio equals \frac RP RF \sigmap where $RP equals portfolio or asset return. $RF equals risk-free rate. $\sigmap equals portfolio or asset standard deviation volatility. A higher Sharpe ratio indicates better risk-adjusted performance, meaning the asset is generating more return for the amount of risk taken. Download the code on OnePageCode Substack. The Sharpe ratio allows for a direct comparison between different investments, even if they have vastly different return and risk profiles. An investment with a 10% return and 5% volatility, Sharpe equals 1.6, is generally preferred over an investment with a 20% return and 20% volatility, Sharpe equals 0.9, assuming the same risk-free rate because the former achieves a higher return for each unit of risk taken. Putting it all together, investment objectives. The various metrics discussed, simple, multi-period, and terminal returns, annualized volatility, and the Sharpe ratio, are not merely academic exercises. They are practical tools essential for performance evaluation, objectively assessing how well an investment has performed, comparative analysis, benchmarking different assets or portfolios against each other, risk management, quantifying and understanding the level of risk undertaken, investment decision-making, guiding choices to construct diversified portfolios that align with an investor's specific risk tolerance and long-term financial objectives. By thoroughly understanding and applying these concepts, quantitative traders and investors can make more informed decisions, optimize their portfolios, and better manage the inherent uncertainties of financial markets.